Today's speaker, this session speaker, K Vaitheeswaran sir and CA Venugopal sir onto the dais and welcome them with a floral bouquet. Thank you, Pramod. Thank you, sirs. It is my proud privilege to introduce my guru, K Vaitheeswaran sir. Mr. K Vaitheeswaran obtained law degree from Madras Law College and enrolled as an advocate in the year 1990. He also has obtained grad CWA from ICWA Institute and ACS from Institute of Company Secretaries of India. His legal firm operates with physical offices at Chennai, Bangalore, and also provides services virtually across the country. He has 32 years of experience in advisory capacity as well as through appearance before appellate authorities, tribunals, courts in matters arising under domestic and international tax laws, excise, customs, service tax, VAT, CST, GST, FEMA, RERA, company law, and IBC. He has written first comprehensive book on VAT in India when VAT was introduced in the year 2005. He is considered as a specialist in tax and legal matters with in-depth knowledge of business and tax laws. He has addressed hundreds of seminars and conferences on law and taxation across the country and abroad and is the most sought-after legal professional in GST and business restructuring matters. He is an expert in real estate contracts and has recently forayed into technology law and artificial intelligence. He is the member of Finance and Taxation Committee, CII, Southern Region, and President of the Revenue Bar Association and immediate past President of Rotary Club of Madras Southwest. He is also a member of SIC, Indo-American Chamber of Commerce. He is the recipient of Vocational Excellence Award from Rotary. He is actively involved in various social causes through music and also forays into humor writing. With this brief introduction, I present before you K Vaitheeswaran sir. Friends, again it is my proud privilege to introduce my senior to this August gathering, CA Venugopal G. CA Venugopal G is the founder partner of Messrs. Venu and Vinay, Chartered Accountants since 2002. His academic credentials include securing All India 45th rank in CA Final. He is also Certified Information Systems Auditor. He has also completed various other certificate courses from ICAI, namely DISA, course on business valuation, course on internal audit, course on fraud detection and forensic accounting, and many others. He is an active speaker at ICAI on GST, especially on technology and its implementation challenges. He has authored various industry-specific handbooks on GST. He has contributed to the technical guide on GST audit released by ICAI, other publication materials. He conducts workshops on filing returns with use of automation. He has developed a lot of Excel-based free utilities on GST like JSON Reader, creating JSON files, GSTN Validator, composition versus regular benefit analysis, etc. He is a GST faculty for ICAI and conducted various workshops and webinars. His other areas of practice include design and development of internal controls and process documentation, consulting in ERP implementation or migration, management consultancy for business analysis and growth, and design and management information systems. Apart from audits, he is hands-on coding in VB, .NET, R, Python. He also reviews database design. He has conducted various workshops for corporates on use of technology, improve efficiency at work using Excel, building automated reports from accounting and financial applications. He was behind the development and managing of cloud applications like TaxSmile, Insta Financials, and others. With this brief introduction, I present before you CA Venugopal G. Over to you both, sir. Thank you.
Very good afternoon, and it's my privilege to be here sharing the stage with Vaitheeswaran sir, where I have learned the exercise, and also good to see so many participants. And ICA conducting, Bangalore branch conducting only real estate related seminar, so it's very focused and objective. And yesterday I was a participant sitting there. I know the challenge of paying attention, ensuring the sleep doesn't come. Yeah. There are also participants at a mix, some of them fully into GST, some of them especially only into real estate, some of them are freshers. So to ensure that everyone are at one pace, what I will be doing is I will be taking over the various legal provisions so that everyone are at the common platform. And Vaitheeswaran sir, as the session progresses, he will be touching upon the issues each sector by sector. When it comes to the GST, especially real estate industry, some set of people think it's pretty simple law. So you just pay 5%, everything is done, so there's no issues. Then there is the other set of people who say that it's too much complicated and many things are there. However, I feel it's also pretty simple. And per se real estate, I've been looking at the contribution of real estate in the India and the GST per se. Now, this sector actually has contributed substantial amount to the GDP. And I was also seeing the RERA registration, the state-wise. Of course, Maharashtra has been top, and Karnataka, Telangana also have a decent share. And I was doing little deep dive in the statistics basis the registration, how much the contribution of GST and RERA is happening. And when I saw over last 5 years, there are around close to 6,000 projects which were registered, both plotted development and the apartment constructions. And around 1,80,000 crores is the size of the market share in the Karnataka alone. Now we all know broadly the rate of tax, is it 1%, 5%? So basis different project types, and plotted development has its own tax structure. Just if we assess, there's around 10,345 crores collection to the exchequer. And overall Karnataka share is 9% in the total GST collection. Going with that rate, around 7% is the contribution from this sector alone to our same GDP is at 13%. This is real estate is second revenue generation and the employment generation to the GDP. So that way this sector is very important, both from the government perspective and the economy perspective. So let's start with understanding what are the basic provisions of the law when it comes to the real estate. And I'll go a little basic. So there are two schedules which we definitely need to know, Schedule 2 and Schedule 3. And Schedule 2 is classification between a supply as a good or a service, and real estate has been classified as supply of service. But however, the levy is more linked to the time of completion and the time of supply. If I'm making a supply or a sale before the project is completed, so it is treated as works contract. But if my first receipt, my first collection itself is happening after the completion, then it is an immovable property, so it's outside the levy. So at a broad level, post OC or CC. Now CC is used as commencement certificate, CC is used as completion certificate. In the state of Karnataka, we don't have the concept of completion certificate, and that is where I've used the word OC. Now, GST Act doesn't use this word OC. We use it here, the occupancy certificate. Now, is it right, wrong? Is it logical to use? Maybe again litigative. But again, a common man understanding, if you are making a supply post OC, it would fit under Schedule 3 and there wouldn't be any levy. Since this is not like a shelf product, you are selling it over the phase of the completion of the, whether be it a plotted development and sale or an apartment construction and sale. In fact, see, real estate, when we see infrastructure, there is a road, buildings, canals, various projects, but whole of today's discussion, we would be restricting more towards an apartment and the plotted related transaction. So this would be treated as a continuous supply of service. And the moment you are saying it is a continuous supply of service, every milestone you are collecting the money, maybe you are booking a plot, an apartment in 10th floor, but some collection is happening when the foundation is done or something. No, even you didn't even see your floor, but the invoice is raised and monies are collected, like it is deemed some service and supply has been done. All right, so you can't wait till everything is completed, possession is given, and the invoice is raised. Yeah. So we got to also look at when the supply triggers. So the invoice has to be raised basis the milestone. So when we say continuous supply of services, it could be earliest of or anything which is known. So some of the builders enter into a contract basic 5%, 10%, 20% basis each of the slab. And sometimes the customers have a money power. They may come and say that, okay, I would make upfront payment and want to gain some discount. So earliest of these things happening, it would be treated as supply. It would be treated as if there's a levy. So you cannot say that the levy will happen only in this one straight fashion. So that is where 13 subsection 2 says earliest of either invoice, or if you are not raising invoice, and especially in real estate, the invoice concept is kind of, I'll say myth. It is a demand note that is raised. So you should treat the demand note as the invoice, because the demand is raised basis the schedule which is agreed at the time of the sale agreement which is made, or the payment which is received earlier. Another concept which I would want to touch upon is credit note, because again this industry keeps thinking, can there be a credit note at all? Because unlike the sale of goods, when the goods are returned, there can be concept of credit note. But even here, again, going by the FAQs and the common understanding, see, the agreement was that I entered into an agreement to get a flat. Now, I might want to upgrade from 2 BHK to 3 BHK, or the builder is delaying and I want to walk out of the project. The question that comes is there a deficiency in the service, in the supply of service, or whether at all there is no supply at all, supply did not even happen. Having the invoice being raised and the service not being delivered, there is still a chance that yes, the supply did not happen, and the credit note can be issued even in the real estate transactions. So when the moment the credit note is issued, so the builder has an option to set off of the credit which the builder has claimed. And the time limit of credit note, now the stands revised. Earlier it was the due date of the September return, but now up until 30th November. In fact, just before the lunch break, there were some questions that came up. There are a lot of projects which have extended much longer period, and this 30th November credit note time limit doesn't, because this is by next financial year. Only after 2 years, 3 years, you are upset with the builder because that he is not delivering it, or whatever be the reason, builder himself is walking out and anything could happen. At that point when the cancellation happens, who has to bear the GST? Like builder, when the buyer is paying, he is not buying an apartment as 1 crore plus say 5 lakhs GST. For him, he's saying, what is my consolidated amount I have to pay for this, right? So for him, he is paying everything towards an apartment. He says when a cancellation happens, he expects the full amount of the refund that needs to happen. Yeah. So this is one again issue which is litigative. Just to support this answer of can the credit note be issued, again in the FAQs issued by the board after the new scheme of thing, even they have said the developer shall be able to issue a credit note, and they have given instances where the credit note can be issued. Like one of the instances which they have discussed is where when someone was entered with a 12% scheme and later they switched to 5% scheme, can this credit note be issued? They said yes. And they have also said if someone has cancelled the project in between and walked off, can I issue a credit note and refund the full amount? The board said yes. So this is one question that keeps coming, is whether credit note can be issued or not. Right? So these are the basic provisions one should be aware before we get into the GST related relevant notifications and the issues. Till 1/4/2019, there was a different law. Post 1/4/2019, these are the notifications which are like per se, I would say, an act by itself. Like if you see 3/2019, it is a 50-page notification, which talks about various provisions as to how one has to levy the tax and what about ITC. It is like a Bible for this industry. And the next most talked about subject is the development right. What about is the taxation of the development right? How much is exempt, how much is taxable is dealt in 4/2019. Where it says the landowner is exempt, and 5/2019 says that let the builder pay both on the long-term lease premium and both on a reverse charge basis. At what time it has to be paid is 6/2019, equivalent to 4/2018. Just pardon me for these numbers. But yes, those who are into real estate, these are the notification numbers are essential. If at all you are looking at doing an advisory to a client, or if you are doing any of the clients into real estate, it is essential you know 3, 4, 5, 6 and 7. These notifications are must. One should be aware. However, we will get into these little detail. So to start with understanding what are the rates of taxes. The rates of taxes for the builders, affordable housing project, we say 1% and 5%, they're actually effective rate. That's not the rate of tax. 1% is not the rate of tax, 5% is not the rate of tax. The rate of tax for affordable housing project is 1.5% and 7.5% for, I'll not say not affordable, other than affordable. The right word to say is other than affordable housing. Now, what does the affordable housing means? They have again said if it is a metropolitan city and not metropolitan city, the quantum and the area both needs to be fulfilled. In case of a metropolitan city, the carpet area should be around 60 square meters, and the carpet area, all the definitions have to be referred to the definitions which are given in the RERD Act. So the carpet area in case of a metropolitan cities is 60 square meters, other than metropolitan 90 square meters. We know when the collection from the buyer, please note, when the collection from the buyer is both including land and construction, then land has to be deemed at 1/3. So if the contract is including land and building, even though you have two separate contracts but you are collecting it simultaneously, the deeming provision comes in, because the Act used these entries used under 15 subsection 4. So the deeming provision comes in, and only 1/3 needs to be given a deduction for the land, irrespective of the actual value. Again, whether right or wrong, again Vaitheeswaran sir will take up in those issues. Apart from making payment of this tax, there are other conditions. Of course, we have seen residential projects, affordable, other than affordable. There are other projects which are commercial projects. The commercial project rate of tax is 18% on the again 2/3 portion, so effective rate is 12%. If it is an ongoing project, which means the project which has commenced prior to 1st April 2019 and it's still going on, there's an option given to the builders, developers to continue at the old rate, which is still at 12%. Now these new rate of tax have come up with an additional conditions. One needs to satisfy these additional conditions. The conditions is, first of all, this rate of tax you have to pay only in cash. There's no way you can utilize input tax credit. If you have multiple businesses, today there is no bar that one has to do under one GST number, one business. If there are multiple businesses, the input tax credit arising of that business still cannot be used for the real estate project related. You still have to pay the liability that is arising only in cash. The second thing, given that it is a discounted rate, the input tax credit is not permitted. Now the moment input tax credit is not permitted, you cannot also scout for some unregistered vendors and purchase materials and try to save your ITC. There's another condition, at least 80% of the procurement should be from a registered persons. And this 80%, what does the quantum would include is leaving salary with schedule 3 items and the TDR and the reverse search items. So the rest of the procurement you should be doing from the registered person. So if my total project cost is, let's say 100, let me eliminate say some 10 as the schedule 3 items. Make sure that the balance, put it at 80% of it by purchased from the registered person. The TDR, the most spoken, we will again see it. The TDR is to be now paid by the developer. Again, there are two words for the developer. Whenever I'm using the developer or the promoter, I'm referring to the builder, because when you see 3/2019, there are two types of promoter defined: landowner promoter and developer promoter. So whenever I use the word promoter during the session, I am meaning it only towards builder, because from the RERA perspective, even landowner is also a promoter because he is causing in that project. So if something goes wrong, even landowner is also responsible. So when we use landowner promoter, yeah. So the reverse charge is applicable on the development rights by the promoters. Now, so before we look at the issues in the joint development and the rate of tax, I will give a glimpse of the taxation of the way the taxation works. Then I'll hand it over to Vaitheeswaran sir to dwell upon the issues in the apartment construction development. So broadly, if we understand the way the business is happening, so the landowner is venturing and coming into the project saying that, see, I have a bare piece of land and I do not have an ability to raise money. I do not have the knowledge to get approvals, get construction, sell. I do not have any of this. So he will enter into an agreement, and I'll start with an area sharing agreement with a builder, saying that I am not selling the land, I am giving you a right to develop on the land. So what does the builder do? He constructs an apartment on that land, and since it is an area share, a portion of an apartments are shared between the landowner, a portion is retained by the builder. What does they do? Eventually they want to sell. Some of that would be sold before the occupancy certificate. Some might lie as an inventory, as on the date it is not sold. So it could be for own use, or it is sold after the completion of an occupancy certificate. Same goes with the landowner. Even he makes a sale of certain units before the OC. Some he might again retain for himself. Broadly, this is what happens. And when you look at from the taxation perspective, there are various supplies that are happening. Let's look at each of the supply one by one. The first and foremost supply that happened is the landowner landowner has received construction of apartments. So he got some apartments from the builder. So there is a supply of construction services. Now, builder has built some apartments and gave it to the landowner, so that is a supply. So there is a forward charge levy on it. Builder has also sold units to the end customer, so even this suffers a levy forward charge. Again, there is no input tax credit. Those units which are retained by the builder and or which are sold after the completion certificate, technically this is a Schedule 3, there is no levy. However, there was a development right that has been given by the landowner to the builder. As we discussed in the earlier slide, the development rights are under reverse charge. So this is kind of an indirect levy on the unsold units. So the government says the entire development right is towards the whole of the project. The development right is towards whole of the project. On this, some units have been constructed and given to the landowner, you have paid the GST on it. Some units you have sold to the end owner, you have paid the GST on it. Let for the unsold portion, you pay the GST in the name of the development right. Yeah? So that's the thing. Now, when it comes to the landowner, so landowner, this is kind of like a trading commodity. I'm just giving you an example to understand. So landowner has got these units and he is selling it to the end customers. So for landowner, he can sell these units same at the 5% with the input tax credit. With the input tax credit, because the first levy already happened. The condition there is the value of the supply that landowner is doing should be higher than the value at which he has collected, the ITC he has availed. So there should be an incremental cash flow to the government. And those units which are retained, of course there is no levy, but the input tax credit attributing to those units will be suffering under Rule 42 and there will not be any levy. That is the area share. If I have to swap this and make it as a revenue share, if we treat this as a revenue share, in a revenue share, the landowner would say that, see, even I don't have an ability to sell the units, even my units you keep it with you. I don't want even my units, all the units you please sell and give me a collection. Like if the landowner, the area share, let's say 35% to the landowner, he will say 35% you just give me the cash. Now in an area share transaction, the entire onus of sale is on the builder. The same thing would happen. There are some units he has sold before OC. So the builder will pass on a portion of the collections to the landowner. A portion of collection to the landowner. Now, the unsold inventory on the date of the OC, either units are passed on or they will continue the agreement and say that, okay, I will pass on the revenue of that the transaction on the date of OC. Now when it comes to the taxation, the units of the landowner also is with the builder, so there is no concept of the forward charge. So unlike in the area share where the builder has paid towards those units, so that concept will not be there, so there is no construction service to the landowner. And for the units which have already been sold to the end customers, the tax is fully suffered, so it's a forward charge with ITC. For the units that are retained, the same concept of the development right which we have seen, the development right tax will be applicable for the unsold units. This when it comes to the builder perspective. But when it comes to the landowner perspective, the money that has come to the landowner, it has already tax suffered. It is an appropriation of the collection. So there is no question of again making an additional levy on that. And the same goes with the units which have been sold after that. And there is no concept of input tax credit because there is no levy. Entire levy is happening on the units directly being sold by the builder. So if I have to just to summarize, if there are 100 units the builder has constructed, let's say 60 units he has retained and 40 units he has given to the landowner. Of 60 units, 35 units he has sold before OC, so he will pay forward charge 5%. Unsold units which he is holding, he will again pay reverse charge 5%. And please note, whenever I am using 5%, I am saying that the effective rate, not the actual rate. And for the 40 units which he has given to the landowner, again builder pays on the construction services, again at 5%. Now 5% or 18%, again Vaitheeswaran sir will dwell more. So eventually builder will be paying GST on all the units which he is constructing in one or the other form. And when it comes to the landowner, whatever the units he is selling before OC, let's say out of 40 units, he has sold 15 units, on those 15 units he will pay. For the 25 units which he has not sold, there is no liability. And on the development rights, the residential, it is a reverse charge by the developer, and in the hands of the landowner, it will be treated as an exempt supply. Right? So these are the basic provisions of the taxation for an apartment construction. So I'm pretty now sure that everyone are grounded with what are the tax rates and how the levy happens. So let's look at the issues that will come up in this. So I request Vaitheeswaran sir to take over at this point.
Thank you. Good afternoon. Good afternoon. I need to check whether people are awake. See, Venu is a good speaker, but lunch is also good. So as Venu said, he was my student, and when he was also known to me, and when I came to the hall, I met many faces. The reason is, I had a long stint of even though I'm a lawyer by profession, I love the subject so much I spent time teaching early morning 6 o'clock. And from 1992 to 2012, I was actively teaching CA. It was fun. It was enjoyable for a point of time, and then the schedule was just too taxing, so I stopped it. But wherever I go, I see some face who comes and greets and says, I was your student in Mylapore at this point of time. So nice. I'm so glad to meet all of you. And we had a chat, because when you have two speakers for a particular topic, it becomes important that we do not overlap. It is not fair to the speaker or to the audience. So I had a chat with him, and he was also very kind enough to say that, sir, I will cover the provisions part of it. You cover the legal issues. So we had some kind of jugalbandi discussion as to how do we want to go about it. So he structured this in such a manner. It is first of all, my compliments to you. Very, very well structured presentation covering all the aspects. But going on to the legal issues of what I have to cover, first of all, we need to understand the poor developer. He has to pay to the vendor. Normally you will say, if you pay to the vendor, what is the problem? You get ITC. No, for developer, no ITC. And then, as if that is not enough, what happens if you buy from unregistered vendors? Government got worried. You may buy from a lot of unregistered vendors and keep quiet. Therefore, 80% of your procurement must be from registered vendors. Otherwise, we'll have a deeming fiction for RCM. Then GST on construction for customer, GST on construction for landowner, GST on development rights. And if you manage to finish your project by the completion date based on a RERA compliance, all your ITCs have to be reversed. So what is the fun of being a developer? So sometimes you ask this question. Of course, from an accounting angle, it is a nightmare if you look at how much of ITC is lost. It's a huge cost increase. But from a government's angle, why did this happen? So basically, 5% is what everybody talks about. 5% is the effective rate. Every customer says it is 5%. Every builder says it is 5%. What is this 5%? It is a 5% levy on the total consideration, which comprises of your UDS of the land as well as the apartment. Why did it come? If you remember 2017 when GST came, a lot of awareness was there, because GST was new and it was well marketed by the government, that everybody became aware of GST and everybody became experts in GST. So this public and a set of groups who were not assessees, who did not pay GST nor deal with GST, became experts in GST in WhatsApp. So they spread all kinds of, even now you'll get WhatsApp saying that if you buy for 5,000 rupees, it is 10%. If you buy for 10,000 rupees, it is 3%. If you buy for 20,000 rupees, it is 2% GST. One fellow will, one seasoned client will send it to me and saying, Vaitheeswaran sir, is it true? I said, you yourself asking this. But that is the kind of misinformation and disinformation going on. GST got all the publicity. So every fellow went to the hotel, ate idli vada, took a photo of the bill, and then posted saying that GST is killing 12% GST. Because they had a complex system of GST for hotels. And this negative publicity did not work. Government got upset about it and said, this is not what we want. So overnight they made hotels 5% GST without ITC. For hotels, it made sense, at least to some hotels, because what you buy for your rice and your wheat and your oil, basic oil, not all other oils, it's without GST. Your vegetables and fruits are without GST. So your ITC is not significant. So smaller hotels accepted it. And overall, public were happy about it. But government also became happy because this is a good system now. 5% without ITC. Success. So then around 2017 became 18, 18 became National Anti-Profiting Authority became very active. So when National Anti-Profiting Authority became very active, they issued notice across to every developer saying you must have given the benefit to the customer. Whether you have benefit or not, you have to give. They'll compare your 60-year-old credit with your current credit and ask you to pay the amount. And there were huge demands against various developers, and an image was built saying that developers are sitting in piles of ITC without passing on the benefit to the customer. So the government said, okay, we'll change the law. We will make it easy for customers. 5% GST without ITC. So the idea is, customer thinks is 5% is very low. Real estate has come down from whatever rate it to 5%. But what they do, as chart accounts, you know, if you don't get ITC, it goes into your cost. If it goes into your cost, it goes into your price. So you increase the selling price, but it's still 5%. I'm charging only 5%. So it doesn't matter. So everybody is happy. Customer is happy because he got 5%. Government is happy because they are collecting things. Real estate developers, some of them are happy because it is an easier thing to sell to the customer when it is 5%. But many of them, serious players, big players, keep asking the question, is it the only option? So we decided to bat differently. I said that you bat as per the notification, I'll bat outside the ground. So my batting is going to be very different. I will say why this notification may not apply. That doesn't mean that that is the only methodology. Depends upon your appetite for litigation. So if your appetite for litigation is good, then some of these options can definitely be explored. All of them are sustainable options, not completely out of the sky. So why not developer pay 18% on the construction consideration? Land value can be identified. What is GST? GST is the levy on supply of goods or services or both. That is a levy. It is not on immovable property. Therefore, land should not be taxed at all. So why have this artificial methodology of including land in the valuation, deduct 1/3 as if you are giving some relief, and then tax the amount? Eliminate the land. This is my service. You said construction is taxable. Construction I will pay 18% and take ITC. Because if you pay 18%, you are entitled to ITC. All your cement comes at 28%. Cement is at 28%. So your biggest material comes at 28%. So why not explore the option of availing ITC on the materials, availing ITC on the services. And if you want to still give the benefit to the customer, you can still charge him only 5% because you'll have enough of ITC available. So customer can still get that 5% in the invoice, but you will pay effectively more through your ITC. Is this option available? So let's analyze this 3/19. Somewhere initially Venu said that GST is simple. 3/19 is not simple. GST is actually, if you look at it, it was designed to be simple. I agree on that part of it. It was designed to be simple because supply was encompassing everything. What was goods, what was services, all put together was supply. They merged all taxable events. But the enthusiasm in drafting, I think all of us have this urge to write. So the drafting notifications is so complex. And most of the notifications will be worded like this. In exercise of the powers conferred by section dash of so-and-so act, read with section dash of so-and-so act, read with rule number so-and-so of so-and-so rules, in supersession of notification number so-and-so, so-and-so, in partial modification of notification so-and-so, so-and-so, line 3, the word and shall be deleted. This will be the amending notification which will have a tax impact, which nobody will know. both of us will know. But it has also given us bread and butter because clients come to us. I have seen clients coming to us saying that, can you translate this notification? That is how laws are drafted. 3/19 is like that. And as if that was not enough, they put 3 columns in 3/19 with a bundle of conditions which you have to read along with it. So 3/19 amended 11/17, which is the rate of tax notification for services. So if you go deeper, why do I justify this 18% option? 11/17 is issued in exercise of powers under 9.1, 11.1, 15.5, 16.1. 9.1 is the power to notify rates. 11.1 is the power to grant exemption. Why should they use 11.1 in a rate of tax notification? Power to determine value under 15.5 and subject to conditions under 16.1. These are the powers specified in those sections. Power to notify rates is a very simple power. Section says government shall notify rates. Nowhere the section says that the rate shall be subject to conditions. It can be only a simple rate. But power to grant exemption can be subject to conditions. I can grant exemptions. I can say that a chartered accountant will qualify for an exemption if he meets this criteria. That's a condition. So power to grant exemption flows from section 11. Non-availability can be specified only through 17.5 and not through rate of tax notification. Because if you know, most of you are in active practice, 17.5 is your block credit. 17.5, nowhere it says that the developer is not entitled to ITC. Only the notification says. So can a notification say something which is not there in 17.5? There is no derived power from there. Section 16.1 does not confer power to deny credit. 15.5 requires rules to be framed which have not been framed. So my conclusion would be, based on all this, developer can take a stand that I will adopt 18% for my construction. He can pay under residual rate and also avail the ITC. So the next question would be, sir, notification 3/19 says 5. How can I ignore it and go to 18 for construction? That is why the key word is section 11. If it is a pure rate of tax, they need not have referred to 11. So my interpretation would be that since they've referred to section 11, which gives the power of exemption, 5% is like a concessional or exempted rate with conditions. It is not a normal rate. Rate is something they've exempted to the extent of something, thereby it becomes effective rate of 5% after 1/3 whatever, subject to set of conditions, 80%, blah, 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 all those things, no ITC, you cannot pass on, all those things are there. So it becomes a conditional notification. If it's a conditional notification, there are enough judgments which says that it is not binding. An absolute exemption is binding. For example, if they say milk is exempted, nobody can charge GST on milk. Because milk is exempted, absolute exemption. Milk is exempted if sold in pots. Then that's a condition. So once you have a conditional exemption, you can forego the conditional exemption. Here, this notification is married with conditions. Therefore, there are judgments which says that it is an option, and therefore I will ignore the 5% and charge 18% of the construction and avail ITC. Now, what will happen? 3-4 years later, audit will come. Right? First, we don't know which audit will come. All the audits will come. Then as if that audit was not enough, central government fellow would have completely finished the audit. State government says, I also have power, I will also do audit. So the audit team comes. Audit team comes and says, sir, you have not understood the notification. Under 3/19, you are not supposed to avail ITC. Right? Okay, now I have availed ITC. Since I am availed ITC, I am no longer eligible for that 5% rate. What is the consequence of that? If I have availed ITC, I am no longer eligible for the 5% rate, then the available rate is 18%. Which is what I have done. So that I also get the ITC. So even if an audit query comes at a later point of time, you should be able to explain this, because ultimately the demand would be on that. Saying that since you availed ITC, you are not qualifying for 5%, because they don't want mere reversal of ITC. They would want the full revenue on your transaction. Mere reversal of ITC is not what is their cup of tea. Next aspect is this 1/3 value. What is this 1/3 value? I'm a developer. selling an apartment for rupees 2,000 square feet. That's my selling rate. Each developer has understood the 5% the way they want it. The actual notification, what it says is, take the value, reduce 1/3 towards land, apply 7.5% on it. That's what the notification says. But effect is the same. You know, in Tamil there is a word saying that, if you understand Tamil, padutittu pothinayana, pothindu paduthinayana. That is, if you lie down and put your blanket, is it different from putting your blanket and lying down? Both are same. So effectively 5% is there. So 7.5% minus 1/3 of the land becomes 5%. So developers charge 5% on 2,000 rupees per square feet. Everybody understands that. So the question is, this 1/3 value, is it the only option? So I'll give some examples. Land consideration 10,000 per square feet. Construction consideration is 5,000 per square feet. Deduction under notification 1/3. Taxable value becomes 10,000. Can the assessee adopt the land value on actual basis and eliminate it? Because if you go 1/3, I'm paying more. The point is not I'm paying more, I'm paying on the land also, which is again GST. GST is on goods and services. So by giving a notional deduction of 1/3, indirectly land is getting taxed where the land value is high. City projects. Take your heart of Bangalore. Biggest challenge. The selling rate will be very high. Or heart of Mumbai or heart of Chennai. 25,000 rupees per square feet will be the selling rate. 22,000 rupees per square feet. Land will be the biggest chunk in terms of value. So can the assessee adopt the land value on actual basis, ignoring 1/3? There is a customs case in the case of Wipro. In Wipro, matter dealt with valuation. In import, after the goods are imported, you add certain items like freight, insurance. The law said, take the actual freight. If it is not available, take 20% of FOB. But for handling charges, they said, take 1% of handling charges. So Assis said, I have the actual data of handling charges. How can the law deem that 1% shall be handling charges? Supreme Court said, yes, you have every right to substitute the actual value. That Wipro judgment has been applied by the Gujarat High Court in the GST matter, where Gujarat High Court in Munjal Manbishi case has held that even under 11/17 in respect of construction services, it is possible for the developer to adopt the actual land value as a deduction in case the actual land value is higher than 1/3 deduction. Made it very clear. So if it is more than 1/3, do the actual land, and then on the effect construction value 3.75 CGST, 3.75 SGST, matter is over. Again, you can't do 5% there. You can't take the double advantage of 1/3 there again on that. Now coming to joint development rates. Today, JDA agreement in my office, I am virtually the arbitrator between the individual and the developer. Both are my clients. And both of them say that we know that developer is your client, that's why we have come to you. Developer says we also know that the landowner is your client, that's why we have come to you. And what do you expect from me to solve the problem? And what is the problem? Developer wants the highest amount of GST. Landowner says nothing I will pay. And some of them have gone to arbitration. And after they've gone to arbitration, matter has gone to arbitrator before a senior retired judge. And the retired judge then calls me up and says, both of them have come to me saying something about GST. I don't know GST, tell me what to do. It's so complex. And it is so unfair sometimes on the landowners who are individuals. See, most of the cases, you have an old house where some 6-7 relatives together own the property. The only way they can get some money out of the property is to demolish and develop it. They don't have the funds. As he rightly said, they'll go to some developer and say that, can you do it? This is nothing but a commercial solution. The ideal solution would be for the landowner to sell the land. No GST. But developer has no money. All of them are living in vacuum. This fellow has property, he is going to get future property. This fellow is to develop future property and sell to future customers. When future customers comes, money will come. And future apartments will be allotted to you, which you can sell and make money. There are JDs which are struck for 10 years, 11 years, 12 years, 13 years or nothing. And if you have a litigation on the property, let me tell you, it is a nightmare. One relative says, I am a relative who has been missed out in the transaction. 7 of you have mentioned, signed everything, I am the 8th fellow, you have missed out, therefore I am filing a suit, everything is stayed. You can't move an inch. So JDAs are quite complex. Earlier it was the income tax season. Every tax law, have a pound of flesh in the version article. So income tax says we will focus on JDA. So income tax was completely focused on JDA because there is a Bombay High Court judgment which said as soon as you ink the joint development agreement, transfer under capital gains has taken place. I'm sure somebody must have talked about it yesterday. Chaturbuji they would have talked about, and then the law that changed. So that was one case law which played havoc over all JDAs for income tax season. Then finally government understood and they brought 45(2)A or 45(5)A and made a special provision saying that we will postpone the income tax liability to the year in which completion certificate is obtained. And as if that was not enough, that section is badly drafted. That section is badly drafted because it is confined to a registered agreement, thinking that all JDAs will be registered. In most parts of the country, JDA is not registered. Karnataka, I know they register. And it covers only individuals HUF. It doesn't cover others. So at least some solution was arrived at in income tax. So after income tax, service tax came. How to tax this joint development agreement. So there was a circular which played a big role. So typically, what happens in a joint development agreement? You have the biggest question today. I have signed the joint development agreement before July 17. Am I liable? I have signed the JDA because most of the JDAs are quite old. I have signed it before July 17. Can GST be imposed on the landowner under a method which is set? See, developer will pay GST on what he sells to customer, no problem, because he is going to collect from the customer. Whether developer can charge the landowner GST in respect of construction done under a JDA which was executed prior to implementation of GST by applying all this 4/18, 6/19 notifications. The answer is no. Why? For every transaction there is a consideration, without which there is no supply, there is no GST. Now what is the department saying? Builder is providing construction service to owner. Okay, he is not giving it free. What is he giving it against? You are giving your land. You are diluting your ownership of land. You are giving up a percentage of land in lieu of getting new apartments. Next question. When did I give up? I gave up when I signed the JDA. I gave up when the JDA was executed and power of attorney was given and possession of the land was given, which all happened before July 17, which means consideration had moved in the service tax regime. If you want to issue show cause notice for service tax, that period is over. Nobody can issue show cause notice for service tax. That is over. Completely gone. Extended period also over. Time bar also over. Therefore, for a consideration which has moved in the service tax regime, you cannot give it a color of a GST transaction and tax it. This is the fundamental philosophy. And if once you grasp the philosophy, case laws will come. That's how I operate. I try to understand the nature of transaction, get the philosophy, hunt around, you will get an answer. And there are enough answers. Tribunal in the case of Sri Lakshmi promoters held that if JDA is before 17, then no service tax is applicable, whether or not sale before 17. Because in service tax, in July 10, there is a major change in the system of taxation for developers. They are very clear, JDA signed before that will not tax it. Then Karnataka High Court. Before GST, Karnataka levied K VAT on various transactions, sale of goods, etc. Lease of goods, etc. Before K VAT, there was a Karnataka General Sales Tax Act. Very seniors will know. So KGST was there. So a lease agreement was signed during the KGST period. Lease rentals were received in the K VAT period. State Department said you have to pay K VAT on your lease rentals. Assessee said, my lease was signed during KGST period. There is no fresh lease from me during the K VAT period. There is no transfer of right to use goods. You cannot tax it. Karnataka High Court accepted in the case of Lease Plan India. Therefore, 4/18 and 6/19 cannot apply when development rights had moved earlier. Now coming to the next aspect of the JDA. He was talking about models, different models. So revenue share model, it's a very, very practical model which developer and landowner both don't want. Reality, but it's the best model. Developer and landowner don't want because the landowner feels that the appreciation of the future apartments which he gets in the future will be much more bigger than the revenue that he gets. All notional. Okay? The palace of illusions. Developer wants that money. He doesn't want to share. He says, I'll give it later, I'll give us units, because for him unit means construction cost only. It's only construction cost. Efficient construction cost, it doesn't have much matter. But revenue share is a tax efficient model. Why? Because no construction for owner is happening. No allocation of construction areas for the owner is happening. All flats are developed and marketed by the builders. Percentage of revenue shared with the owner. Only risk is you have to carefully draft your agreement so that you don't land up as an AOP. Your agreement should not make both of you an AOP, in which case income tax will come. So that alone, if you are alert, then you can implement this model. And whether there are decisions for revenue share, there are enough judgments. There are enough judgments in service tax which said that there is no service rendered by the appellant and the money flow to the assessee under the nomenclature of royalty is not a consideration for rendition of service, but represents appellant's share of revenue. So it's a share of revenue not liable to service tax. Same judgments in the context of cricket. Flow of money from one person to another cannot be taxed. Calcutta Cricket Club, all other clubs. Then you have, in the context of revenue sharing, even in the context of real estate, Neeraj Prasad. So there is a number of decisions in the service tax regime which can come into play. Now you go to area share model. In your experience, if you have handled JDAs, you will find that every JDA has got at least 4 or 5 supplementary JDAs. JDA will be signed in 2014. Then 16 one supplementary, 18 one supplementary, 19 one supplementary. They'll keep on supplementing some clause or other. Basically, their share, what am I getting, what you are getting will keep changing. That depends upon the construction cost going up. If the construction cost goes up too much, developer says, I can't give you 40 apartments as promised. I'll give you only 35. Then big fight. Then panchayat, then agreement. Because ultimately the owners are helpless because they have signed everything, given possession. Power is given. The developer is helpless because he needs the power of attorney. The power of attorney should not be cancelled. And Tamil Nadu, one more law is there. There are too many fraudulent power of attorney transactions. Therefore now they say, whoever gave the power, he must be alive. Obviously. So each time you present a document, get a doctor's certificate that he is alive. Imagine NRI power. In most transactions, owners are NRI. So you get the power, get it signed before the foreign commission and then bring it here and register within 30 days. As is not enough, you must execute within 30 days, failing which you have to get a life certificate from the doctor. Imagine a US doctor giving a life certificate to a NRI fellow. Like this insurance company, they insist on a life certificate. If you're entitled to money under the policy, they will ask you, are you alive? My father has got a very good sense of humor. He's no more. When he was getting this money from LIC and they asked for life certificate, he went to the counter and said, yes, I'm alive, give me the money. No sir, somebody has to certify you that you are alive. We have absurd laws. We take it to different levels of absurdity. So share of constructed area. Couple of questions. All these are already touched about by Venugopal. Now I will try to give non-tax positions. I told you, take it with a pinch of salt. Non-tax positions are available in 2 circumstances. 1, you have not paid and department comes and asks. You are not aware of the law or you had some issues, you have not paid. Department comes and asks you to pay. Do you have an answer to defend? Second, you are willing to bite the bullet and take the litigation if it comes, provided there are judgments to support. So one view, this started from the decision of the Hyderabad bench of the tribunal, which applied tremendous common sense logic. What is the common sense logic here? I am a developer. Venugopal is the landowner. He gives the land to me and says, sir, develop it. give me 60 apartments, you sell 40. Agreed. Now for me to construct the 100 apartments, I have to incur all the costs. So the 60 I am giving virtually free, but the expenditure I have incurred. Will I say, oh, yes, I have incurred, what to do, loss, my life is like that, my joint development agreement is like that? I will not do that. I will cover all the cost in my selling price of the 40. Yes or no? So I will cover every cost incurred in the selling price of my 40 on which I pay GST. So the Hyderabad tribunal took a view saying that he has already captured the entire construction cost in the selling price to the customers. He has paid service tax on that. Why are you asking him to pay service tax again? Brilliantly analyzed, and they looked at numbers, and based on the numbers they said yes, data is available, no service tax can be imposed. This one was followed by the PNR Infra, another judgment of the Hyderabad bench of the tribunal in the case of service tax. So one view is that no tax can be imposed based on these two decisions in service tax, which are to be tested in GST. The philosophy is the same, therefore it should be tested in GST. Second aspect, when he gives the joint development rights to me, he loses something. He was a proud owner of the entire land. He is now a limited owner of the 60% of the land. That means 40% of the land he has lost or given up. Why is he giving it up? Only because I am constructing apartments for 60 apartments for him. Therefore, the 40% of the land given up is nothing but the consideration for the 60 apartments built for him. Take the land value, pay GST, pay 18% GST, take ITC also. This is one more method. Now, where is the authority for this? Funnily, the authority comes from a consumer case. In Fakir Chand, landowner and developer signed a joint development agreement. Developer did not honor his obligations. Apollo no RERA. In fact, that's another side question. Why? What is the need for RERA when Consumer Protection Act is there? The answer from the government was, no, this is special consumer, therefore Special Consumer Protection Act is RERA. Because if you get a defective product, you can go only to consumer court. You don't have a separate law for it. But for real estate, you have a separate law. So, the Fakir Chand case was, developer did not honor his obligations. Complaint was filed under the Consumer Protection Act. The lawyer for the developer first argued saying that, you are a landowner, you are not a consumer. Second, this is a joint venture and not an agreement for construction. Third, I am not providing any service to you. Fourth, you are not giving me any consideration to me. All these four questions are relevant to GST. Supreme Court answered saying that in a joint development agreement, the developer is providing a service to the owner. The consideration is nothing but the land given up by the owner. So the answer that the land value could be consideration comes from a direct Supreme Court judgment. So if you apply the analysis of Fakir Chand, then one can take a view that I will pay GST, but not on what you are saying, by selling rate, etc. I will take the land value given up, and on that I will calculate 18% pay. So this was the notification which he talked about, 4/18 and 6/19. I am a lawyer. So when I see a notification, I dig deep. When I dig deep, I find that all these notifications, two notifications, key notifications have been issued under 148. What is 148? Government may, on the recommendation of the council and subject to such conditions and safeguards as may prescribe, notify certain class of registered persons and the special procedures to be followed by such persons, including those with regard to registration, furnishing of return, payment of tax and administration of such persons. This is meant for convenient schemes of taxation for registration, administering a chunk of assessees, etc. This does not confer the power on the government to issue a notification on taxability of transaction, because that notification says this is taxable. You can't do that. The power is only in the context of procedures and process and not for determining liability, if any. So GST on landowner share, what are the options? Complication further by bad drafting of the JDA. Because what happens in JDA is, either lawyers are involved who are not tax lawyers, or the company had engaged some lawyers 20 years back and paid him his fees and got a joint development agreement. They've been using that same template continuously. Arbitration, single umpire by the managing director of the company. Probably illegal. You cannot have arbitration by your own employee. Those clauses will be there. So they've just borrowed the same template. So the effect of the template is that all taxes pertaining to developer shall be paid by the developer, all taxes pertaining to landowner shall be paid by the landowner. Nobody can understand this clause. So how do you then determine that the developer has got the right to collect the tax from the landowner on construction? So if the agreement is bald, mad ends there. Biggest of arbitration disputes have been won on the agreement not covering it. If the agreement does not cover GST, it does not cover GST. Some agreement says expressly service tax. Some agreements are smart. Service tax or GST or any other new levy by whatever name called that may be introduced by anybody. Smart, well drafted. That will cover for centuries. You can recover it. Why go to such an extent? Take today, I don't know, some of your clients could be property owners or you may be property owners. You might have let out your property to a bank. It is such a nightmare to collect service tax from them. It continues to be a nightmare to collect GST from them. Despite banks falling under Ministry of Finance. Why? Because most of the lease agreement, standard agreement will be that all taxes pertaining to the property shall be to the lookout of the landowner, property owner. That is for property tax. Nobody imagine GST. So banks are saying clause is not there, I won't pay. As simple as that. So the agreement drafting is very critical. Assuming you've done a good drafting, then there are options available. One is no tax position, or I'll go by the notification. What the notification says? Notification makes the developer inquisitive. Developer has to see where he has sold this apartment. At what point of time? What is the selling rate for that? Borrow the selling rate. Now this itself is funny because the selling rate for the buyer captures your cost also. Understood? The selling rate for the buyer captures your cost also, captures marketing, advertisement, sales promotion, publicity, sponsoring events, everything would have been covered. Whereas the cost incurred for the landowner is only construction. He already owns the land. You're only building for him. Therefore, this adoption of comparative rate and eliminating 1/3, if the notification suggests you follow the notification, that is a method available. But you can question it if you want. So since the land is already owned by the owner, GST at 18% for construction carried out akin to a contractor. You are the owner of land, I am building for you. 18% GST. Value can be comparable rate, value could be guideline value could be agreed rate. You put in the JD itself, what is your agreed rate? So and so rupees per square feet. Or value can be cost plus 10. Cost of construction 3,000 rupees per square feet, add 10%, on that I will pay the GST. So the GST on landowner is one option. 4 options are available. Now coming to this development rights. I don't think 3/19 has understood development rights. With due respect, I'll say this. Because we need to understand what is the real transaction between an owner and a buyer, owner and a developer. He gives me bundle of rights. Right to develop is only one right. He gives me right of access. He gives me right to enter. He gives me right to demolish the existing building. He gives me all the permissions to apply for from various authorities. He gives me the right to sell undivided share of land or land. That's a key right. He is giving a right whereby 100% ownership became 60%. That means 40% of immovable property rights he has given under the JDA. He also gives me a right to develop the property. So development right is one of the rights which are conferred by the landowner under the JDA, but the laws assume that development right is the only right that is there, and therefore they should tax it. Indirectly they're taxing land. So the law, he already explained 4/19. there is an exemption notification subject to a condition that in case you get CC and you have unbooked units, your developer has to pay GST on the developer rates under RCM at 18%. And they have given calculation as to how to calculate the GST, carpet area, etc., etc. So fundamentally, development rights itself can be considered as immovable property. So what happens in immovable property? It cannot be subject to GST. Why development rights is immovable property? There are enough judgments which have explained what is rights in land. Immovable property means not only property but also rights in property. In fact, there is one judgment which says a ship in a water is immovable property. Can you read this? A ship in a water is immovable property because water is part of earth. Ship is also on earth. It is not water, it's not separate. Therefore, there are interesting views as to what is immovable. Fishing rights have been held as immovable property. So development rights, if you consider immovable property as benefits attached to land, it will take the character of immovable property. If it takes the character of immovable property, then can there be a GST on development rights? So this is an important question pre-1419 for the landowner and post-1419 for the developer. Because there are some officers who are taking a view that pre-1419, owner himself has to pay GST on development rights. Post-1419, they say, okay, developer has to pay. Both of them can take a stand that is immovable property. As far as owners are concerned, there is one more advantage. If the department comes to the owner prior to 1419 and says, for 1718 you signed a JDA, you gave development rights, please pay GST on it. His simple answer can be, one, development rights is immovable property. Second answer, please tell me how it is taxable. There is no mechanism for taxation. Third answer, is it a supply? Under the definition under 7.1a, supply must be in the course or furtherance of business. A 95-year-old landowner who is not able to hear what is going on in the discussions about joint development, but his grandchildren are making him sign the document or press his hand on the document, ancestral property is giving away through JDA, how can you call it a supply in the course or furtherance of business? It is not his business. Therefore, it is not even a supply. Second answer would be for 1419 onwards, if it is not a supply in his hands, can it be subject to reverse charge mechanism in the hands of the developer? Because for RCM to apply, it must be a supply. So these are all avenues available in terms of contentions. And I always say that I will never talk through my hat. I will have a supporting principle for something. There is a direct judgment. In the case of Banushali housing, in order that the transaction must be treated as a business transaction, it must be a transaction that answers the above discussion of the both parties to the transaction. For the developer, it is business. For the owner, it is peace in the family. JD is nothing but peace in the family. Bhayankara Sanda, they were keeping on fighting. Grandchildren are not talking to each other. 3 kitchens are in one house. How to solve all this problem? Get the whole thing extinguished. So it is not business, it is something else. Then one interesting case law came before AP High Court. As chartered accountants, you are aware that one point of time India also had Wealth Tax Act. Right? There was a Wealth Tax Act. Then they abandoned it because the collections was much lesser than the cost of implementation. I don't know whether this budget inheritance tax might come. There are stories going around that inheritance tax might come. So when Wealth Tax was there, Wealth Tax was not applicable to stock in trade. So this person signed a JDA and said that this was my land. I signed a joint development agreement. I am in business now. This is my stock and trade. Therefore, no wealth tax. AP High Court said that no, owner of land cannot be found to be intended to carry on business using the subject land as stock and trade, since he may well have decided to part the land for other reasons also. So JDA, same facts, old man, etc., signing a JDA, he wanted to argue it is business, matter went against him. So that judgment indicates that it is not a supply in the course of furtherance of business. Now coming to valuation of development rights. See, this is a double whammy. The developer is required to pay GST on the 60 apartments constructed for him by adopting a selling rate. Photo. Then the government said, that is done. Okay, next. What next? Development right. You pay tax. When do you pay tax? If you are a smart developer, you will pay tax. What do you mean by a smart developer? A smart developer is a person who does not waste time, quickly marshals all his funds and resources, and quickly builds up everything, goes to RERA and says, I've completed in time. Booking not done. 300 apartments in the complex, 12 booked. Now he will get hit by this provision. To the extent of the carpet area that is unsold or the unbooked apartments, he is supposed to pay reverse charge mechanism development rates, and for that also they borrow the selling rate. So the selling rate is borrowed for construction of owner as well as construction development. That itself dilutes the entire scheme. Then comes a question. How can you take a selling rate as the basis and deduct land when development rights is something else? Okay, we agreed for construction, you said similar apartments. But for development rates, where is the similar development rates? There is no computation mechanism for identification of value of development rate. As I said, 5 or 6 rates are coming, only one is getting picked up, and entire amount is calculated. Therefore, the famous, all CA final students will know, BC Srinivasa Setty's case. We'll somehow use this case law in some problem. So answer is, if computation fails, levy fails. This famous case law is applied across in many cases. Wherever rules are inadequate, valuation mechanism inadequate, provision is inadequate, Srinivasa Setty will come to your rescue. Government has tried their level best to nullify this, they are not able to nullify it. Because it is case specific. For example, in capital gains, if cost of acquisition cannot be determined or cannot be identified, there cannot be capital gains. Srinivasa Setty says so. So government said, okay, what are all the revenue, where all transactions are happening? Sir, he's selling bus rights. Bus rights, no? You have a right to operate a bus in a particular route. He's got looms, textile looms. Those rights he's selling. He's selling leasehold rights. There is no cost because they're all inherent rights. So government said, wherever lease rights, loom rights or bus rights are given, cost shall be taken as nil. So now 0 is a number. Computation is available. 5 crores minus 0, 5 crores is taxable. So wherever they could see taxation scope, they amended. But they have not amended fully. There are even number of transactions where Srinivasa Setty will apply. In fact, this case law, if it is missing in any challenge in a writ petition, it will be surprised. It will be there somewhere. So quickly moving on to development rights. Options, you can take a no tax position or you can value as per the notification. There are computation challenges and who knows what will change. 3/19 itself was such a big surprise. Ongoing project, one treatment, not so ongoing project, another treatment. What is ongoing, one complex definition, in declaration. All this in a notification which talks about rate of tax. Ideally, they should have created a mechanism of computation for real estate in the valuation rules. They should have done that. Just like how they do for certain transaction money changing, they could have clearly identified how to and allow actual consideration as an option also. Only when consideration not ascertainable, these are the methods. They could have done a proper job. Now, having not done that, all these are under challenge. In Karnataka High Court itself, writ is pending. 3/19 has been challenged. JD has been challenged. So all of them, we don't know what kind of judgments will come, but if judgment comes, again, we'll have to see how it will be implemented. What's the plan next? You have next set of slides? Yeah. Okay. So I'll stop here with that. You will go to 42. And then I'll come back to plots. That's the plot code.
I will take plot and develop.
In the agreement, if you mention... In the agreement between the builder and the person who's buying the flat, if they mention cost of this is how much you're going to pay for the cost of construction, this is how much you're going to pay for the land, will that be tenable for the purpose of tax, or do you have to follow one third in any case?
See, it becomes tricky depending upon the state in which you operate. If your state stamp duty law and registration law requires you to register a single document. So you're buying an apartment. The stamp law and registration law mandates that a sale deed covering the entire apartment has to be executed, assuming. Then the entire figure will be subject to stamp duty, registration fee, etc. But as far as GST is concerned, merely because I paid stamp duty on the entire value, etc., what can be taxed is still the supply portion and the supply of goods and services. Therefore, I can always identify from the guideline value from Karnataka stamp authorities and say that this is the value of the land, this much is the undivided share as per my schedule in the agreement, because he doesn't get the full ownership, he gets only a fractional ownership of the land. This is the value of the land. So from the total price, if the value is eliminated, this is the consideration which represents the construction portion. I will not follow 1/3, I will follow actual, and this is the actual value available. Second, if your stamp law permits, or if you are operating in a state like Tamil Nadu allows 2 agreements. There can be 2 agreements with the customer, one for sale of UDS, one for construction agreement. Values are automatically split. So it depends upon the state. If it is still a single agreement, you can come back and rework it. If it is not, you have straight away values.
So that guideline value has to be taken, you're saying?
Has to be taken.
If you take a higher figure, that's no problem?
No problem. It's all the more, because if you take a higher figure, you can knock off the entire higher value. Yes, will attract GST.
So you mean to say in Tamil Nadu, there are 2 agreements are notified. One is for land sale, which is registrable, and the construction. Is the builders are paying 5% on both, or only on 18% on the construction agreement?
See, what they do is, they execute a sale deed for UDS of land. They execute a construction agreement, both are registered. So X plus Y. They take X plus 5 together and charge 5% GST to the department. This one set of builders. Other set of builders say that we'll pay 18% on the construction agreement. Land is outside GST.
But will that be post 2019?
Post 1/4/2019. I gave reasons as to why. Yeah, I think you were not there at that time.
I'm not there. Okay.
I'll share the slide with you.
Okay, but will that holds in the ISAF law?
Yes.
Okay.
I'll quickly explain. The notification which prescribes 5% refers to 11.
Okay.
11 is an exemption section. Therefore, 5% is like an exemption, concessional rate, like the excise duty rates, with conditions.
Okay.
Therefore, there are case laws which says whenever there is an exemption with conditions, you can ignore them.
Okay, thank you, sir. Any other questions?
So this 2 agreements, even in case of apartment house, villas or property is working well. An apartment, because it is UDS, because how easier how different.
In Karnataka, as I said, they do a single document. Am I right?
Yeah.
So because of your stamp duty compulsions, you do a single document.
Yes.
But I'm saying after doing the single document, you can rework your amounts for GST purposes. In Tamil Nadu and some other states, it is easier because the law permits 2 documents.
Sir, has any developer mustered the courage to do this?
18% on works contract.
On an apartment, generally trying to split this?
There are a number of developers, sir,
Okay.
across the country.
Okay.
Here also.
Okay, great, sir.
Any other questions?
Yeah.
Just to add to that question, not the answer, is still there is a fear, in spite of Gujarat High Court judgment, that further it travels to Supreme Court and gets overturned. So that's where the question still comes that, okay, does people...
I doubt, I'm just stretching my neck here, probably the experience I'm stretching. I doubt it will get reversed because the analogy given in the Gujarat High Court is based on the Supreme Court judgment. It is not an independent thought. As I said, Wipro judgment. They followed the Wipro principle correctly and they applied that analogy and said that if your actual value of land is more than 1/3, you are entitled to take the actual value. Indirectly, what it can mean is, if your actual value of land is less than 1/3, what happens? Nobody knows. Everybody goes for 1/3 then. When the problem will come is, when the department is going to rely upon this judgment, where your actual value of land is less than 1/3, They may apply this Gujarat High Court and ask for more GST. Then Gujarat High Court will become valid. Understood?
The actual value necessarily shouldn't be guideline value or can it be the valuation?
Actual value, there are judgments which says what is the sale consideration agreed between the parties for the land. Guideline value is only some kind of a marker. Can be much above that. It has to be above that because 50C will come to you, income tax. It will be equal or above. So you are entitled to keep a much higher figure also and document it. See, for example, even if it is a single value, single document. Let us say you are executing a sale deed for the entire apartment in Karnataka. You are paying the full stamp duty on it. I don't think any SRO is going to object if you are going to say how much of land value is there. Because you are paying the stamp duty fully. So you can declare what is the UDS value, what parties agree to be very high value, and building value so much. For example, old buildings if you sell, there must be an annexure which values the building. New buildings also, this was the construction consideration, this much is the sale consideration, sale deed consideration, total I am paying so much as a stamp duty, matter over. Then you have the data available to show that my customer has paid. See, customer buys from you mineral water bottle as well as this chocolate, right? You tell the customer you paid 10 rupees for the mineral water bottle, 2 rupees for the chocolate. Nobody can question you that. Likewise, you are telling the customer you are paying me 1 crore for land, 40 lakhs for construction. Over.
Good evening, sir.
Yes, sir.
Now, as per RERA, the undivided share in land is transferred to the association. So therefore, the splitting of construction consideration and UDS, is it possible now because of RERA in Karnataka?
I'll tell you something funny. RERA is a parliament legislation. And before parliament, I'm sure you have heard from Ramesh in the morning, before parliament brought this RERA law, Maharashtra was always ahead in RERA. They had their own RERA, Maharashtra legislation. So parliament virtually did cut and paste of Maharashtra law. In Maharashtra law, you execute a sale deed in favor of the society. What do you do in Karnataka?
No, individual.
Individual. There itself violation has happened. If you go back to that section in RERA, it says that sale deed must be, the conveyance of sale deed must be executed in favor of the society in which the allottee is a member. That is the association. Their ownership is of all properties together in an association. Ownership right of a unit is getting transferred subsequently. That's how it is done. Whereas across the country, you will have sale deeds going to an individual. In Tamil Nadu, law permits sale deed for UDS and construction agreement with separate stamp duty rates. Therefore, the Parliament has enacted a law in respect of a transaction which is different in every state. You get my point? Each state has got their own method of execution because the land and building is a state subject. Stamp duty is a state subject. Registration is a state subject. RERA comes under residual. So they're only regulating it. They can't override the state law. Therefore, you follow the local law. Local law permits sale deed, over. Local law permits UDS construction, over. RERA knows, RERA keeps quiet.
Thank you, sir.
So we'll break for tea.
And one more, I'll tell you a practical problem. In Maharashtra, societies exist immediately. It's formed immediately. Here, when do you form the association? After everything, if you are willing to form. Right? We'll break.
Yeah, we'll break for tea. 15 minutes.
Yeah, we'll break for tea. As early as possible, we'll come back.
Yeah.
So,
but the way notification is worded, it said the exemption for the promoter and land exemption for the landowner promoter and the reverse charge for the developer promoter. The exemption is only to the extent of the residential units. One thing you need to understand is landowner is selling land from his perspective, but from the GST perspective, landowner is giving a right to the developer to enter the land and build the apartment or construct some activity. And as Vaitheeswaran sir rightly said, land comes with bundle of rights. In fact, when any natural resources comes with only a conditional rights. When you are an owner of the land, which means you are owner of set of rights. One of the right could be you can let it out, one of the right you develop on it, one of the right you can mine it, but nothing gives you an absolute right. You do construct a skyscraper or do a deep mining. All this comes with conditions. And when a developer is coming and constructing it, out of so many bundle of rights, you are giving one right to him saying that, okay, fine, you can develop. Post the development, he is also giving off his land. So his value of the land is also given off. So there is a portion of the sale of land which needs to be constructed in terms of the computation. But the way the notification is worded, entire value is attributed to the development right. Okay? And development right is treated as supply of service. So since the development right is supply of service, rate of tax 18%. So technically, if a layman language, what is the development right is only from the computation. Okay, I'm not saying that that's the right thing, is the apartments which the landowner has received. He has parted some portion of the land, he got some apartments. So those value of the apartments are treated as equivalent to the development right. And 18% GST on that is the GST liability. 18% GST on it is the GST liability. So that is what now subjected to reverse charge in the hands of the promoter, builder, developer, promoter. Since this whole of the development right is applied on all the 100 units that have been constructed, so the government said the exemption to the landowner is full, which is that 18% of the development right is exempt, provided the builder pays unsold units. So the numerator is the exemption amount is the full value to the landowner, the total residential, because the commercial is not under exemption. So from the landowner perspective, the exemption is given in full. But from the builder promoter perspective, the exemption is given is whatever is the GST computed multiplied by the carpet area of the unsold units divided by the carpet area of the total units. However, this is subject to, if those units get sold, whatever is the tax liability that comes in, so it is minimum of both. Still, it might be confusing to someone, so what I have done is I prepared a simple Excel just to get a fair understanding of it. Let me just... So, Excel is not coming. All right. So Let us just take one simple understanding. There is one unit which has 5 floors and 6 units in each floor. So that means there are totally 30 units. Now, each 30 units are sold. Some are retained by the landowner. So some units are retained by the landowner, and some units are retained by the builder. Some are sold, some are unsold. So if I have to just summarize these numbers, I've just put it as the numbers. So landowner gets 40% of the area, which is say 24,000 square feet. Builder is getting 60%. In terms of absolute units, out of 30 units, landowner has 12 units, builder has 18 units. Let's say in this 12 units, landowner has sold 10 before OC, 2 remained unsold. Builder has 15 sold before OC, 3 remained unsold. Now, in terms of the taxation, the reverse charge is applicable, the development right is applicable on the unsold portion. The question that comes is whether the unsold portion we should recognize the 5 as an unsold portion for computation or only 3. The answer is only 3. Let's see how and why. Now, out of the total units, out of the total 30 units, see 12 units has been sold to landowner. From the builder perspective, out of 30 units, 12 has been sold to landowner. Even though the landowner has sold only 10 before OC and 2 he has retained, but from the builder perspective, what did he do? He has sold all these 12 units. So this 12 units will be suffered under forward charge. There is no concept of reverse charge. So even those 2 units which is remained unsold in the hands of the landowner will not come under the ambit of development right reverse charge. Second, the 18 units which is retained by the builder, 18 units which have been retained by the builder, 15 he has sold before OC. So this 15 would be under forward charge. This 15 would be under forward charge. So the 3 units that were remained unsold, only that, the concept of the development right under reverse charge would come in. And how is that computed? For the 12 units which have been sold, now, the 12 units is like a barter. The builder has given to the landowner and landowner has given his undivided share of land. In fact, going by the earlier judgment which Vaitheeswaran sir has mentioned, if I am the builder, I am not getting a single rupee of money from the landowner for the units which I am giving. The units that I got, I am selling to the end customer, and all the monies that I am getting from end customer, I am paying GST. See, technically the consideration should have been restricted to that, but since there is a barter, so there are multiple transactions are happening. In the first instance, I am selling construction units, I am buying undivided share of land, again I am selling it. So there are multiple transactions, so that is why we have to dissect and tax it. So for the units which have been sold, 12 units which have been given to the landowner, so the levy would be for those 12 units, it is taxed at the value which is nearest to the date of joint development agreement. Because on the date of the joint development agreement, supply is sale or agree to supply. So I have agreed to supply, so the liability is arising as on that date. Now again, interesting fact which sir again brought in is the notification which drafted 4/2018, that the power under that section is for payment of tax. That section did not touch the time of supply. Now, how do we interpret that? Did the levy arised? The levy happened on the date of joint development agreement. Only the payment of the tax is deferred to the handover or allotment, or the levy itself has been shifted to the OC date. These are the two different points that we need to look at. When we talk about time of supply, the time at which the supply happened, or the time at which we are making the payment of tax, should the both be read hand in hand. So again, I also agree that the time of supply happened on the joint development agreement date. It's just the payment of the tax is postponed to the OC date. Given that the time of supply happening on the date of JD, for the units which have been handed over to the landowner, I have to adopt the value of the units as on that date. And we all know, whenever a project is launched, the price at which it is launched is different. Between the launch date to the completion date, you will have the escalation anything between 15 to 20%. There would be a difference in the price. So for these units, you will adopt that rate, and 5% of it is what you will be paying. And for the units which have been sold before OC, these 15 units which have been sold before OC, you will adopt the rate as and when the rate happening. For the unsold units, which are 3, is which I want to talk about, the development right taxation. Let's move to understand the taxation of the development rights. So for the unsold units, the notification says, wherever the value of the supply of service by way of transfer of development right against the consideration in the form of the apartments, then the value of the similar apartments has to be taken. Given that the taxation of the development right is happening on the date of OC, I have to take whatever is the value of those units on the date of OC for the computation of development rights. Now, they have given 2 mechanisms. Firstly, there are apartments that have been given to the landowner by the developer. Is 12 apartments have been given. The carpet area, if we go, the total value of the development right for this example is 16 crores. The GST on that 16 crores is 2.87. This is exempt in the hands of the landowner. But in the hands of the developer, this 2.87 is multiplied with 2 aspects. The 2.87 is multiplied with total carpet area is 60,000 square feet. Unsold as on the date of OC is those 3 units. So around 5,000, 6,000 square feet of the carpet area is not sold. So the entire 2 crore 87 lakhs is split in this ratio. So that means 27 lakhs is what the developer has to pay as a reverse charge liability on the date of OC. That is option 1. They have also said that if these units are sold in a normal course, I would end up paying only 1% or 5%. You compute even that tax. So they have also said, if these 3 units are sold, if these 3 units are sold, and whatever, let's say as on the date of OC, if 9,500 per square feet is the rate, I would have the transaction value is 5.6 crores. At 5%, I will be paying 28 lakhs. So the government said it is lower of 27.82 or 28, whichever is lower. Like instead of 9,500, assuming if this is say 8,000 as on that date, so I will be paying 23,60,000 as against 27 lakhs. So it is lower of these 2 has to be considered as the taxation of the development rights in the hands of the promoter developer. All right. So let's move back to our presentation. Again, I will only give the understanding. The issues on the plotted development will be dealt by this. Now, there are a lot of questions that also come up is, can at all there be a GST on the plotted development? Is there a concept of development right which is given in the plotted development? Should plotted development not be under Schedule 3? This is the first question. The second question that comes up is, even assuming if at all there is a levy, would the levy be fitting under 3 War 2019? Because 3 War 2019 use the word apartment. And going by the definition of, there are 2 things, project and apartment. Under RERA, project includes, plotted development is also a project under RERA. But would the apartment consider the definition of the plotted development is another thing. So even assuming if there is a levy that happens, can that levy be at 5%? So should I apply the rate of tax as 5% or should I apply 18% at what value? So these are the questions that come up. And also the question comes up again in the plotted development also, there is a share which is happening. So what should be the levy? Now, given that there are multiple questions, that means the multiple tax experts or the professionals took a different positions. Till the law is not settled, each position has its own challenges of saying whether it is right or wrong. I will not say whatever right now I am saying as that is the law, the way one interprets. And if someone who is not do not have an appetite to take risk, would want to have a safer position. But honestly, what is safe also don't know. If I take a position that I will pay tax at 18%, officer may come and say, no, apartment means including a block or a chamber on the piece, so I will consider this and you pay at 5%, you reverse ITC. This can come in any way also. Now let me, in my understanding, what does the plotted development, how does it happen? Again, the plotted development, let me pick that area sharing, where in a plotted development, the converting the barren land into plots for further development. Converting the land into plots for further development. So, when the plot comes to the developer, as yesterday again the speakers mentioned, the power of attorneys are given different types of power of attorney. In a joint development for the purpose of an apartment, the power of attorney is different versus here. Here the power of attorney would be limited to applying sanctions, all those things to conduct an development activity. But in case of a JD for an apartment, the power of attorney would also include the UDS for further selling. So here the right which is given by the landowner is to seek permissions. So the developer is first going to obtain, get a plan drawing done. Once the drawing is done, he goes to the respective authorities for sanctioning. He will get the sanctioning of the plot. Once the sanctioning is done, he is going to do the leveling of the land, and he is going to do an under the sewage or the drainage systems, all those activities he is going to do. He will also put roads on the plot. He will also going to make it into with the STP, clubhouse and all those things. He is finally making it into a different plots. Now these plots are shared between the landowner. He says some of the plots will belong to the landowner, some of the plots belongs to the developer. Now this is the activity on ground that is happening. When it comes to the taxation, so there are plots that now landowner has which is selling onward to the customers. There is a plots which are the builder promoter which is further selling it. Again, in a plotted development, the developer will be getting a smaller share, maybe 30%, 40%, while an apartment it is a reverse thing. So these plots, when they are sold, would they fit under Schedule 3? Technically, they are the land that is being sold, which is a Schedule 3. The question that comes up is, at what point I am selling? Am I selling it after I get the OC and completion? I need to relinquish the roads, everything to the respective authority after that, or much before? Technically, I am doing it much before. So as and when they launch a project, that time itself they will take the booking. So in this transaction, so let's say the total land which has been engaged for developing, whatever the plots which have been given to the landowner, land already belonging to him. So was there a requirement of handing over plots, unlike in an apartment construction, by the builder to the landowner? The answer is no. So in my view, since there is no kind of transfer, there is nothing levy that comes. Let's say various pieces of the land parcels belongs to some to the landowner and some to the developer. The plots that are being sold to the end customers, could be by landowner. So it is before OC. The plots which have been sold by the landowner before OC are the after completion. Or by the developer, could be again before or after. So some of the units are sold to the end customer. Now these units which have been sold to the end customers are technically supply of land. So Schedule 3, no levy. But where is the question of taxation here? If you look at the developer has developed the entire land. Now I will change the facts a little bit. If I am the landowner, I engage you as a contractor, not a joint development, I engage you as a contractor, asking you to level and do all the activities that we have listed. What activity that you are doing to me is a works contract. That would be definitely subject to a levy of GST, yes or no? Yes. Right. Let's say what we have agreed for is 5 crore rupees. So as a works contractor, would you pay a GST of 5 crores or not? On 5 crores at 18%? Yes? Okay. After or during, at whatever be the time, I express my inability to pay that 5 crores, and I would say that I would want to settle it by way of giving you some units. Let's say I will give you some 100 units in this whole development. You sell and you will collect it. Isn't that a barter where the 5 crores is converted into land? So when the units that have come to the developer, that is in exchange of the works contract that has undergone. So the units that the developer has got, he has sold, could be before OC or after OC. Okay, there is a vehicle 3186. It seems it is blocking the way of someone, so the car key needs to be given. I don't know which color, which make, which brand. They only gave me 3186. I don't know how many of you remember your car key numbers. Okay. So there is a supply by the developer to the landowner, right? Now landowner and the developer may choose to retain those plots, may choose to construct further and do something. That's a different activity. But the levy is happening to the first activity. Now instead of giving you 5 crores when the plots have been given, so how do I value? When there is a barter that is happening, you got to value those land to levy the tax. What is the value that I adopt? Should I adopt a guidance value or the value which I am selling? Technically, the value which is being sold would be the nearest value, so you will adopt that value. That doesn't mean that you are paying GST on the sale of land. You are only borrowing a value for another value. That's where the question comes, which is a superior right, which is an inferior right? Can I equate those values? That's again a debate. But conceptually, there is a levy that happens. Again, sir would delve in detail on plotted development. So before I hand out, there are some more points which I want to cover on RCM and the ITC. So I'll just complete that and I'll hand over so that it will be in a flow, sir. Okay. Again, going back to the other, now I'm taking the other notifications. So which we have on the reverse charge. So where the developer has to pay a reverse charge. So first we saw the TDR reverse charge and we saw the computation. What are the other set of reverse charge which the developer has to pay? 80% of the procurement is from the registered buyers. So if anything shortfall from 80%, you pay under 18%, just hold on. But RCM on the cement and the capital goods has to be at the actual rate. The moment you pay something under RCM, it is deemed as if that is a registered purchase. So the computation of 80% should be restricted up to whatever you are paying. So not that the entire unregistered purchases you will be paying the thing. Up to 80%, whatever is the shortfall is the one which you will pay. and capital goods have been notified, whatever is the applicable rates that you will be paying. And this, at what time I have to pay? Okay, this is the only entry under 9 subsection 4. Whenever we talk about reverse charge, 9 subsection 3 is what we look at. Only for the works contract we have unregistered purchases. But other than works contract, all other reverse charges notified procurements. So the levy is input and input services 18%, cement whatever the rate, current rate it is, that is at 28%, capital goods which is the applicable rate. So notification 7/2019 deals with it. Will all the unregistered purchases comes in here? And one of the classic example or a question that I would want to put up is during the course of construction the developers will take a loan. Now, the interest that is paid on that loan would also fit under this 80% transaction. Again, plain reading, technical reading, unless otherwise you fight on the principle, can there at all be a supply, is interest a supply, and till you sort that question, if you, given that the exemption has been given for interest under notification 12, if you are making an interest payment from an unregistered person, even that will be fitting under this 80% rule. Now, is it justified? Is it right? I am not getting into the logical aspect of it, but the way it is drafted, the 80%, only schedule 3 items are excluded. Your salary is excluded, right? Other than that, for your TDR, which is under reverse charge, you exclude that. Other than the schedule 3 items, all costs would be coming under this 80% rule. And you have to do this project to project basis. If you have, as an organization, you have 4 projects, the computation has to be done on the project to project basis. The question that comes is, what about the corporate office expenditure? How do I allocate? Again, law is silent, FAQs are silent on that. So whenever there is something which is silent, either, so you can use BC Srinivas case or logically allocate the expenditure and see whether it fits under 80% or not. When do I pay? Every year I have to pay. So I have to maintain project wise and pay this at the end of the financial year. End of the financial year, not later than June. This is other than cement. For cement, they said this has to be done month over month and you have to remit month over month. The question that comes up is, let's say in year 1 I am shortfall beyond, because I am doing a computation year over year. Over 3 years I am well good over 80%. My procurement, registered procurements were over 80%. But year 1 and year 2 there was a shortfall, which I have paid. Can I offset? The answer is again no. So because the mechanism of computation is asked is year on year. Again, litigative view, so there is no right answer or a straight answer. The computation mechanism says 80%. Sir, please correct all those things, whatever I am saying. Yeah. And how to make the payment? They have mentioned that you make the payment through DRC 03 because this is neither a supply separately. Initially they said they will give a mechanism and everything. Finally they notified that paid through DRC 03. Yeah. So I'll move to the last part of my deliberation, which is on input tax credit. Given that there is no input tax credit, ideally there is nothing much to discuss. But however, there are 2 types of projects. One is REP, another is RREP. Every project is a real estate project. But if you have a residential element to it, it is called as residential real estate project. What does it mean? Today, every high-rise residential buildings, ground floor, they will set aside some portion to the commercial, where there would be a medical shop or a grocery shop or whatever which needs to be, and they sell that UDS. So they have mentioned again, so something as RREP and REP. So if the commercial portion is up to 15%, it will be deemed as if it is residential. And the rate of tax would for it also be at 5%. Only if the commercial portion is higher, then you have commercial and residential. Residential will continue at that 1% and 5%. Commercial will continue at your 18%, effective rate 12%. Now question that comes is, in any apartment where you have commercial and residential, you will not buy the steel, cement and tiles and other equipment separately for the commercial and separately for residential. So that means entire procurement is a common procurement. So given that the entire procurement is a common procurement and some portion is subject to ITC, some portion is not subject to ITC. So the ITC in a REP, commercial you get the ITC, residential you don't get the ITC. So how do I bifurcate? It is not on the sale value. The bifurcation is not on the sale value. Bifurcation has to be done basis the carpet area. Basis the carpet area of the project. In fact, even this Rule 42 itself is a big debate because this amendment came in only after 1st April 2019. The concept of carpet area allocation, everything came up only after April 19. What happens to the projects prior to April 19? Should I go with the same logic? Because that was year over year, exempted turnover divided by total turnover. But now, exempted carpet area by total carpet area. What is the carpet area which is exempt? Residential carpet area is exempt. Commercial carpet area which is not sold as on the date of OC, because after OC it becomes a Schedule 3 supply. So residential carpet area plus commercial carpet area which is not sold as on the date of OC, to that extent your ITC is blocked. Divided by total carpet area is what you have to do. Now, how and when will I know unsold carpet area of commercial? Only at the time of OC I will be knowing it. That means Rule 42 is a mechanism you apply year on year. Again you apply on the date of OC. So that you make this adjustment of reversal. If you could have reversed higher year 1 and lower year 2, you will do a computation once in a year and also at the end of the project. Same thing is applicable to Rule 43. Because the capital goods, you will not buy any of your capital equipment, something for commercial project and residential project. The capital goods reversal computation is very challenging because the capital asset will be lying idle. Your project to project, you are using it and sometimes you are not using it. It is shifting one, at least in the Rule 42, it is simple, the procurements which you have done towards the project. But the capital goods move from one project to other project and that project has various things. Looking at the matrix of the computation, in fact I had prepared one utility to plot. It is like your depreciation schedule where you are allocating. That is pretty simple. Asset procured and your life of the asset you are allocating it. Here the asset is procured, you divide it by 60, compute the ITC. Each month, where is that asset lying? Towards residential, towards commercial, how much to take, how much not to take. Some periods the asset is lying idle, that it is not even used, so you have to compute, park it, all those things. And looking at that computation, one will say it is better not to take ITC and get into Rule 43. Yeah. So this is on the ITC portion. Yeah. So we will move back to Sir on the issues that are there in whatever the items that I have discussed. Yes, sir. Over to you.
Thank you. I don't think I have a slide on 42 and 43, but what is 42 and 43? 42 and 43 are mechanisms created in the rules in a scenario where the government feels that you should not get full ITC because there happens to be a revenue stream on which you are not paying GST. That's the old Rule 6 of Senvat credit rules. So you jump from 42 to 17, Section 17.2, 17.3. That is the source for 42 and 43. 17.2 and 17.3 says that where inputs or input services are used partly for taxable supplies and partly for exempt supplies, then credit is restricted to the taxable supplies proportionately. So the focus in the statute is a supply. And that supply must be a taxable supply and an exempt supply. OC or CC, as it is called, is an event. It is not a supply. I have applied for OC, I have applied for CC, I got it. That's all. It is not translating into a supply, it is not translating into an exempt supply. Therefore, the entire basis for 42 and 43, by focusing on your completion certificate, saying that as soon as you get the completion certificate, everything is over, you have to reverse everything, can be tested. By the simple analogy saying that, where is my exempt supply? Where is your link to 17.2? I have not covered the slide, that's why I just built on his topic. So now coming to the sale of plots. Developer is developing land into plots and selling plots. Now there are two kinds of transactions. One is the land is purchased from the landowner. Straightforward transaction. Land purchased from the landowner. Landowner receives full consideration. He gives possession. And then does one complication. Both of them sit together and say, why not we save stamp duty? Because if you execute a conveyance deed, you have to pay one-time stamp duty. Then when that fellow sells again, you have to execute stamp duty. They said, we'll give you power of attorney. So full money he takes, full possession he gives, power of attorney he gives, and sometimes they even declare in the power of attorney no money consideration was received. Some of these transactions are unbelievable. And they go to the auditor, their auditor. Sir, auditor will ask, first of all, most of the cases, auditor only tells this fellow what all tax to pay. He looks at the bank account and said, suddenly you got some 40 crores, where has this money come? I gave power of attorney. Now the auditor cannot sleep. Because whether this is a transfer, sale for purpose of capital gains in that year when it was granted, I'm sure yesterday somebody talked about it. Then subsequently, based on the power of attorney, that fellow sells at 75 crores, will it come back to him? Will the differential come back to him? That is a big concern today, but nobody bothers. Everybody signs power of attorney left and right. Landowner enters into a JV with the developer and both are agreeing. He had a nice picture. In fact, his sheet of plots is much better development than real development that you see. Beautiful roads in between, well-spaced roads, square plots, all square plots. I was very impressed by that. Where do you get such plots? He will tell you corner plot, but you don't know which corner. So landowner enters into a JV with developer and both are entitled to agreed number of plots. So going by his example, you sell 50 plots, I get to 50 plots. Now comes the execution part of it. Now this is where the GST can be different. Execution part of it, both of them in the agreement says that I am entitled to 50 plots, you are entitled to 50 plots. For your 50 plots, you execute sale deeds, collect the money, keep it. For my 50 plots, I will execute the sale deed, collect the money, keep it. Then it is a case of sale of 100 plots. You get my point? So both of them execute separate conveyance deeds for the respective share of immovable property and both of them reported as sale of immovable property. It's a third schedule transaction. It will still escape the GST because it's third schedule sale of land. Then comes one more version. This land is a barren land, or today it is not barren land, it is green land. In fact, in one of the seminars, somebody was asking me this question. Sir, what is this greenfield airport? Why do they call it greenfield airport? I said, you destroy all the greenery, you destroy all the agricultural fields, therefore it is greenfield airport. So basically, plots are coming in only fertile lands these days because land is not available. You go deeper and deeper. So greenery has to be destroyed. River has to be frozen, closed. Any other water source, aqueduct, etc. has to be sealed. All grouting has to happen. And that they suddenly, during the course of development, they discover that there is a lake. So they'll give the project name lake itself. In fact, in Chennai, what happened was when 2015 massive floods came, real floods, we really suffered. Of course, Bangalore also went through 1 year to 2 years back. most of the areas which had maximum floods up to first floor, second floor, and nearly more than second floor was called as Lakeview Apartments, Lake Area, Vellacheri, all those names were all probably rivers at some point of time or lakes at some points of time, all slowly converted developments. You see, this is a different racket that happens, and you can't blame the developer, because when the developer buys the land or when he gets the land, it is already converted into various stages. Some 7-6 hands would have changed. If you notice carefully, a fertile lake, when it starts drying, or a river starts drying, it will be dry for a long time. Then somebody will start crossing with the bus, lorry, etc. All that, it will become a route, etc. Then one small taluk office or government office will come. That's the first step. If you notice, if seniors will notice their old village, you'll notice. Then surrounding buildings, again government buildings will come. Then suddenly patta will be issued, or katta, here katta will be issued. Then that's it. That's the end of the story. Till next rain comes, we'll forget everything. So development charges is nothing but these charges which are incurred first to remove all these things and seal all these things, and then to level all those things, and then to put drainage system, piping systems, road systems, lighting, all those things, and sometimes today much more than that, fancy club, convenience, etc. So there is a development charges. So now people are doing two things. I will execute a sale deed for 50 lakhs, not liable to GST. I will execute a development charges agreement separately over and above the sale deed for 20 lakhs. I will charge GST. So they execute a development charges agreement, collect this 20 lakhs, pay GST, wherever possible avail ITC. This is one method that is being followed. Now I'll address all those things. First I'll explain this and I'll address all those things. A developer can purchase land in his own name, carry out all development activities, prepare the layout, and sell the plots in its own name. The tax implications are stamp duty and registration fees. Sale price of the land by the developer to the owner would include the margins and the development charges. Same theory which the Hyderabad bench held in joint development agreement. And the margins and the development charges, and on this sale price the property would be registered and the customer would pay stamp duty and registration fee. There is no GST in the hands of the owner, since the owner is selling only land third schedule. There is no GST in the hands of the developer, since the developer is selling only the land third schedule. Now the question would be, in a joint development or a joint sharing agreement, it is still in principle a transaction involving sale of immovable property. Whether it is a cake that has been sold or cake with lot of icing that has been sold, it is still a cake. So whether it is immovable property sold or immovable property that has been developed into, bettered into much superior immovable property, it is still immovable property. It is still land. So what is being sold is the trigger point for a GST, not or the consideration. When does the consideration hit you? So we have to look at it at a transaction. Okay, both have signed into a JV. Landowner gave the land parcel. Developer did all the development. And in consideration, he is able to sell 40 plots. Owner sells 60 plots. Owner is entitled to 60 plots. So when the 40 plots which he sells, it will be at a much higher figure, but there will be a sale deed for that 40 plots. In the 60 plots that this fellow sells, there will be a sale deed for the 60 plots for the money that he receives. No other money is paid in between for the development charges. So can you impute consideration or you attribute consideration? So I will address what Venu's point when he said that, can you not perceive it differently, that if you engage him as a contractor and then subsequently convert it into a land transaction, will it not amount to a barter? The answer can be different. GST can be levied if there is consideration. Section 231 defines consideration. First part of 231 says payment in money or otherwise. Supreme Court judgment says otherwise should mean items such as money or things which have the color of money, something akin to money, not monetary value. 231 definition consideration second part says monetary value can be taken in respect of inducement, agree to, not to agree to, those categories of services. So they have pinned monetary value only to certain types of activities. They have not pinned monetary value to all supplies. Now that's a legislative lacuna. So one would read consideration definition, one would read money, one would read otherwise, and then take this decision that monetary value cannot be perceived as consideration. If that view is taken, then land cannot be perceived as a consideration for the development activity that is carried out. If then that be the case, there cannot be a GST. Now coming to development charges, one other option is available. I sign a sale deed for 50 lakhs. I sign an agreement for development for 20 lakhs. Can a customer say, land mattum porumpa, I don't want development. I want only the land. You keep the development yourself. Can he say that? No. Can the seller identify saying that for this fellow I will sell only land, for this fellow I will give land plus development? Which means that development goes along with the land, and therefore one can borrow the definition of composite supply. Composite supply definition, if you borrow, sale of land is the principal supply, development charges is incidental to the sale of land and connected to the sale of land and takes the same character of land, therefore land is exempt, land is not taxable, development charge is also not taxable. So development charges, two views. And I give both the views in my opinions. Because it depends upon the client. The client says, sir, I have lot of ITC, I want to charge GST on development charges. Another fellow says, I have my own inherent capabilities, therefore I don't need ITC at all. Then incidental supply will work. So development charges can be identified as incidental to the principal supply, in which case you may say that entire thing is composite supply, and there is already a judgment in the context of electricity cables and electricity cables where they have said composite supply will apply even to exempt supplies or even transactions are not taxable. Now going back to Rule 42, see, something really nasty happened in 1419. What happened in 1419 was, if you say that I want to continue as ongoing project, you are entitled to old rates for your old project subject to conditions. But if you shift to the new scheme, you are called upon to reverse everything. Right? You are called upon to reverse all your ITC, including transitional credit. And separately, NAPA will issue show cause notice saying, please pass on the benefit of ITC. Where will I give? Most of the developers who have shifted to 1419 were forced to reverse their ITC. At one point of time or other, they've reversed the ITC. Therefore, there's nothing to retain for you to pass on. But NAPA still issues show cause notice saying that you have not passed on the benefit of ITC to the customer. What does NAPA do? NAPA compares your GST credits with your pre-GST credits and says that there is a difference. Then we are trying to argue saying that you are not factoring increase in cost because of GST. Because of GST, you have to engage so many consultants. I have to attend so many seminars to understand this GST. All this involves a cost. What about that cost? And I have to implement software to understand vendors whether he is filing returns or not. So my incremental cost also I have to factor when I fix my price. So NAPA is separately dealing with all those things. But for a real estate developer, special provisions are there, as he rightly said in 42 and 43, which is all linked with completion certificate. Completion certificate, in my view, is an event. And in the past, Gujarat High Court said, completion certificate does not trigger SENVAT reversal. Gujarat High Court very clearly said that completion certificate does not trigger SENVAT reversal because it is not an exempt service. The same analogy should apply to GST to say that it is not an exempt supply at that point of time. Next question will be, okay, today you may escape. What happens tomorrow when you sell that immovable property? Because your CC has come. When I sell it as an immovable property, it is neither supply of goods nor supply of services. What is third schedule? Third schedule is brilliant. Whatever is there in the third schedule is neither supply of goods nor supply of services. Anything in the third schedule does not affect 42. Because if it is not a supply, how can it be an exempt supply? Therefore, real estate developers in 42 and 43 have got a different kind of a battle when they deal with completion certificate. And as he rightly said, capital goods, I know some developers who said, no, I'm not claiming ITC on capital goods. We told them what to do. They said, no, we'll read the opinion, but we're not going to implement capital goods ITC. Because anyway, there's a pain. So they're going through this pain. So coming to my last slide for the day. Development charges. Chennai bench of the tribunal in the case of Hallmark Infrastructure has held that service tax cannot be levied on consideration collected as land development charges. Tribunal accepted the arguments that development activities are undertaken before sale of land and hence the service is a self-service. Somebody was asking me this question about self-service. And there is no service provider, service recipient relationship. So the concept of self-service can always be brought along even in the context of development. And fundamentally, without developing the plot, I cannot sell it. So these are all costs which I incur. Development is critical for the plots to be identified as a marketable plot. This is a judgment I referred to, Gujarat High Court. Principal supply of transmission distribution of electricity cannot be done without electric line, electric plant, and electric meter. And therefore, tax liability is treated as a composite supply. By applying this case law, you can probably contend that development charges is incidental to the principal transaction of sale of land and hence outside GST. Developer sells the land. Revenue share model. You do whatever you want. You develop it whatever way you want. You sell everything. Give me 25% whenever it hits your bank account. Is there a supply by the landowner? Answer is no. There is no supply by the landowner. Even assuming you say that landowner is giving development rights for consideration, can such development rights be subject to GST? Notification 6/19 refers to construction in lieu of development rights. It does not talk about sale of plots in lieu of development rights. You had that question in the break. Can it apply to monetary consideration paid development rights? The answer is no. Now this is a tricky one. Power of attorney transaction. Landowner gives power of attorney and permits developer to develop land into plots. Landowner receives consideration being share of sale proceeds. Can this be seen as a sale of land in the hands of the owner? Department's contention is very simple. You gave only power. You have not transferred title. Therefore, it is not sale of land. Both for tax purposes, both direct and indirect, they take this stand. What happens if the plots are sold at a higher price in transaction where the owner is paid an upfront amount? Mumbai Tribunal, the case of Viraj Estates, held that purchase and sale of land does not fall under real estate agent services. Almost identical facts. Where power of attorney was there and then the value was subsequent was higher price. Department said the difference can be taxed as a real estate agent services because you have not transferred title. It's only a power of attorney. One cannot sell something which one does not own or has title to, and hence activities are in relation to sale of land from owners of land to buyers of land. All that was considered in Mumbai held in favor of the landowner and the assessee. Insofar as power of attorney, I'm sure the earlier speaker who talked about Sanjeev Lal, where Sanjeev Lal said that if right is created in favor of the vendor is restrained from selling the said property. So you may have to demonstrate that certain rights have been given to the developer through my agreement. I have lost complete control and possession of the immovable property. I have handed over possession. Proof of possession handing over is also available, subject to the Balbir Singh judgment, where registration is required for these kind of transactions. You can still demonstrate that rights have been given and hence it's a transaction in immovable property. So this is what you should be careful. Possession must be given. Full payment of consideration. Agreement should support this kind of a transaction. All rights must be given to the developer. Be careful as to what treatment you adopt in income tax. The same should gel in GST. There's one more parcel of real estate which I'll cover called as long-term lease of land. Now this is a funny notification. There is something called as upfront amount, salami, premium, development charges, etc. Huge amount. You have your Karnataka Industrial Development Corporation, Tamil Nadu Industrial Development Corporation, Bombay, Maharashtra Development Corporation. All of them give this long-term leases of plots. 33 years, 66 years they give. Two conditions. One, you are supposed to do something as per the lease deed. Second, you must pay a huge sum like 50 crores as money upfront, as salami or premium. And yearly rental. First question that arises is, whether the upfront premium or salami that is paid can be consideration for a supply of service. Is it not a consideration for right to acquire the lease? And the yearly lease rentals are only the consideration. Renting of immovable property is a service, no doubt about it. But what is the consideration for renting? Yearly 5 lakhs I am paying. What is the consideration for giving the lease? 50 crores. So there was a debate. People said it is not taxable. The industrial bodies were upset by the GST on it. Therefore, states represented to the center. And therefore, the center said, why not? We'll give a simple exemption and close it off. So they gave an exemption saying that services by way of granting of long-term lease of 30 years or more. Industrial plots for redevelopment or infrastructure. Who should give? State government, Industrial Development Corporation, undertakings by any other entity having more than 20% ownership. Who should receive? Industrial units or developer. Where? Industrial financial area. Then they got even more paranoid. We may give to this fellow. What happens if that fellow violates the condition? So the exemption has been granted. Then the worry is that the lessee might violate the condition. So they put an amazing clause. Where there is a violation or subsequent change of land use, original lessor, lessee, subsequent lessee, buyer, owner, chartered accountant, seminar attendees, delegates, staff of hotel, all of them will be liable.
What happens if they have written part of the money?
Which one, sir?
Financial corporation, state financial corporation, returns part of the money once they take over.
That is another angle. Suppose I paid 50 crores for a 99 years lease. And then I surrender it and I receive back, after 10 years I use it and give back the money of, let us say, 25 crores or 30 crores. Then I can always say that supply is cancelled to the extent of the residual period of lease. Whatever GST paid earlier, in case it has been paid, is no longer payable. Since Sitco, whoever it is, has paid it, he cannot claim refund. I am the person who has borne the brunt of the tax. Under section 54, I am entitled to apply for refund and you can ask for refund. So I don't know how they would even implement this, because they're talking about a violation by a lessee, subsequent lessee or owner, etc. And then they try to say, somebody, all of you have to say, I need the money, somebody has to give me. With interest and penalty. Exemption with conditions is possible. But can conditions be imposed on subsequent lessees, buyers, when the original exemption for the lessor? Who are you putting conditions on? Levy is on forward charge mechanism and exemption is for the lessor. Can there be a condition and creation of a joint liability? None of these are legal. Whatever is done in this entry is completely violative of all existing provisions of law itself. There is no special provision you need to look at. You don't have to go to the constitution itself. It doesn't fit into any of their provisions itself. Now coming to leasehold rates, the first one I talked about, where you get a right, you pay a lump sum salami. Let us say it is for less than 30 years. Or it is more than 30 years, but the lessor is not Sitco, Titco, Kitco, etc. Somebody, landowner, is giving you lease for less than 30 or even more than 30. Exemption is not applicable. Now is it taxable? Answer flows from some of these case laws, where they have said that leasehold rights is immovable property. Leasehold rights can be considered as immovable property. If you consider leasehold rights as immovable property, there is no question of GST on it. Interestingly, you have a very interesting income tax case law. You have your 194I of the Income Tax Act, which is applicable to TDS in respect of renting of immovable property. So the department went to the developer and said, you have paid a lump sum to so-and-so company. It is nothing but renting of immovable property, deduct tax at source. Madras High Court said that upfront payment made by the assessee for acquisition of leasehold rights or immovable property for a long duration of say 99 years cannot be taken to constitute rental income in the hands of the lessor, obliging the lessor debt TDS under section 194(1). They followed various old judgments, including Panbari T, which is a very famous case law as far as salami is concerned. But there are matters pending before other courts. So you cannot take a straightforward view that this judgment will apply. There are disputes pending in different courts. But this argument is quite valid. So what does the developer do? First, he has to understand GST. Most important, his advisor must know GST. I'm not making fun of any professional, but the law is very, very complicated. Whoever is the advisor has to spend a lot of time understanding 3/19, 464/18, 6/19, all the notifications put together and apply in context. It is not an easy task. It is quite a challenging task for any professional. Even more a challenging task when you have to argue before courts, because they have to understand this. And their understanding will depend upon lawyer properly explaining it. So we can also, if a lawyer goes up, matter goes, the judgment can be anyway. So the developer is facing a huge challenge in indirect tax. 5% looks very attractive, but behind the 5%, it's like when you see a duck swimming, no? You see beautifully lovely blue water, the duck is beautifully grazing there. You go and see under the water, it will be furiously flapping its feet. It will be struggling to just stay like that. That is the developer story. They do so much. This is apart from the RERA. RERA at least is clean because you have clear provisions, what to do, when to do, how to do, what geographical positions for your land, all those things. My only grievance with RERA is that you did such a wonderful job. Why can't RERA be the only approval? Is there any developer here? How many approvals are involved? Just take a number. How much? 32 to 40 approvals. If you're a big project, then tall building, then you have to go to DGCA also. Civil aviation. Because plane might come and hit you, plane might get worried about the building, all those clearances you have to worry. So the number of approvals have not diminished. RERA is becoming an additional approval. Had RERA been the only solution, it would have been fantastic. But they can't do it because all these are state also. State, local authority, anybody who's an authority will ask for approval. Traffic, police approval, those kinds of things are there. It is not an easy business to be in. It requires a lot of patience and it's a waiting game to start getting your product selling. Somebody was talking about in the post-tea break. Lot of developers are now come to a conclusion that on one hand, we enter into an agreement, collect money from the customer, he writes email every day. On the other hand, somebody goes to RERA, I have to go there and appear. There is so much of stress. I have lots of money. I will myself develop the property. Complete it fully. Get the completion certificate. Then advertise. Ready to move in units, 50 available. 1 month later, 30 available. Like that I put. What is the implication? Nothing. Blissful life because no GST. Anyway, ITC was not there, under 5%, so it doesn't matter. You have no pressure from customer. And it is easy to sell projects which are completed. The customer is able to see the project. Before, you could only imagine where the project will come and where it will be and all those things. So now the trend is slowly changing towards fast completion. Quickly complete and then get out of it. There the problem is, you must be able to get out of it. If COVID kind of thing comes, and post-COVID IT company decides that we will all work from home, all the business they decide to work from home, then there's no rental requirements. So the stagnation happens. Income tax law does not look at it sympathetically. If you hold the property after completion, they'll ask for notional rent, income from house property. Utilities and facilities. That's another question that keeps coming up. What happens if I put up a clubhouse later? Tower A, Tower B, Tower C, Tower D. Chairman was very clear that you must finish the club before itself. Developers' worry is, Tower A is 2022. Tower B is 2025. Tower C is 2028. When the fellow comes to 2028 Tower C, this club is over. Old it will be. It will be outdated. Table tennis will have only one side of the table. Swimming pool steps have already fallen inside. Okay, you can't maintain unless you spend. And spending means association has to spend. The association will say that we can spend to the extent what we can spend, because there is also a GST on the association. That is another story. Welfare associations, residential association, 18% GST. Madness. 6 flats are there, big flats, therefore more than the threshold exemption. 18% GST. fourth floor flat, the top floor flat is not talking to the ground floor flat. Ground floor flat says, I'm not using the lift at all, why should I pay? This is the dispute between them. And one of them gets a WhatsApp saying that GST is not applicable for welfare association based on mutuality. So whoever is at treasurer that day decides that we won't pay GST anymore. Next treasurer comes. His friend is a chartered accountant. No sir, that judgment has been nullified. Calcutta Club is no longer good law. You will be barbad hua. Interest will come, penalty will come, your association will be closed. Half the time this is their battle there. And what is their revenue? They collect 8,000 rupees and spend 8,000 rupees. Sometimes more. From their capex which they have. Because what do they spend? Lift maintenance, garden maintenance, water utility, power utility. How can government even think that this is a service and tax it? They should have exempted it long back. Every year we keep shooting this claim, please exempt these societies, please exempt these associations, but answer is no. So utilities and facilities, if you want to finish the club and make it ready for Tower A, Tower C it will not be easy for maintenance. So your agreement drafting becomes critical as to when you have committed the club. If you have committed the club and that is part of your consideration for Tower A, you have to deliver club. So some developers have now come with a new idea. I will keep the club and the blueprint of that land for the club outside this project. I will develop it, I will run it, give you access. Dedicated access, not to anybody else, only for the owners. That way I will protect it, I will take care of it, you pay me charges. That is a new model, that will also work. But you should think ahead, at the stage of planning, not later. Land is a big challenge, financial challenge, economic tax laws, IT department wants notional rate, GST department wants to reversal of ITC, and then you have a complex GST structure. As if that was not enough, we had the Supreme Court judgment, which said, pioneer overseas. They gave a brilliant judgment. It was on the context of customers of a real estate project being called as financial creditors. Because in the IBC, you know, financial creditors come in the top. Operational creditors comes in the bottom. So customers, real estate project customers were called as financial creditors. Matter was challenged with the Supreme Court. Supreme Court said, yes, they are financial creditors. They are only funding the project. Only with that money, developer is building the project. Then the parties argued saying that, sir, RERA is there. RERA will take care of any issues in case the developer does not deliver to the customer. Supreme Court said, when IBC was drafted, RERA was in existence. Therefore, when IBC was introduced, the Parliament knew about RERA and still went ahead and called customers as financial creditors. Therefore, IBC will prevail over RERA. In that context. Of course, then the Supreme Court Justice also gave a window saying that if you go to IBC, you may not get your flat at all. If you go to RERA, you may get your flat. So that, question was there in the paragraph. Now, I want to bring an interesting angle and stop with that today. If, as per Supreme Court, customer of a real estate apartment is a financial creditor, and Supreme Court has said that he is lending money to the developer, how can there be any GST on this transaction? Lending is exempt. If customer is a financial creditor for IBC and it trumps RERA, and the word used is customer is lending money to the developer, and when this IBC was created, GST was there. So applying the same logic, Parliament was aware that GST was there. Despite that, they called it financial creditors. With that, I'll stop. Thank you very much, ladies and gentlemen, for very patient hearing.
Any questions?
If you ask who are these three, depends on the agreement. Joint development agreements, landowner, developer, and government. Normal agreement means promoter, customer, advisor.
2 minutes.
Good evening, sir. So the question is, if I am a developer, and I mean the promoter also, the developer also, there's no third party involved. I put my money, develop the land, and I sell it. Okay. During that time, considering the composite supply scheme that you are telling me, if the total cost of the land is 50 lakhs, the guideline value is 50 lakhs and 20 lakhs is for development, just by using this logic, can I collect the entire 70 lakhs in my name without any GST, but the guideline value is still 50 lakhs, I'll ask the client to pay 11% of that 50 lakhs, and the 20 lakhs I'll collect it in the same firm name, I will pay income tax on it, but there is no GST.
Plot or building?
Plot. Yes, plot. Developed plot.
Plot, you have to take, what you're saying is that you're going to recognize 50 lakhs for the purpose of stamp duty.
Yes.
Development charges agreement will not be registered.
Yes.
You will collect 20 lakhs.
Yes.
You can take that stand of composite supply.
Okay.
Rely on the Gujarat High Court, rely on the Tribunal Chennai. Only things, be ready for department saying that they are all service tax judgments will not apply to GST. That's their favorite argument. Then we'll have to apply the judgment. But it's possible. View is possible.
Okay. Thank you, sir.
The same thing, if I take land is for 10 years, I'm developing now, I have my own money only. Take another 2 years for developer thing, I'm selling it now. Can I take it as a long-term capital gain? It's not business.
How have you recorded that land? As an investment or a stock?
No, the land is already lying with me for 10 years.
No, in your books you would have recognized as something, no?
Yeah, land only.
You can answer.
Land only.
Sir,
land only, then we are converting into residential land as a government order.
Yeah. So if you are as a developer, you're in the business of plotted development and plotting and selling. The land parcel, whenever you're buying the land, if you're in the books of accounts, you're treating as your inventory.
Yeah.
It will become a business. But it's an ancestral land, you're one of the thing, it was a capital asset.
Investment.
It was an investment, and at that point it will be a capital gain.
No, I don't debit any expenditure from my office, nothing will be there. There is no business.
There are some.
I'm developing, I'm selling. It's a long-term capital gain for me.
Yeah, so it can be capital gain, but again, we have to see the facts of it. Yeah. Since it's one-off transaction.
I don't run as business.
Yeah.
Nothing want to be debited. There's no rent, nothing there, which I'm observing.
See, because if you look at the scheme of Income Tax Act, there are taxation mechanisms for conversion into stock and trade.
Okay.
So if an investment, something has been held as an investment and converted to stock and trade, Section 45 family deals with it, where it says when to tax it, how to tax it, etc. And it also gives some exemptions subject to conditions also. 47 also gives some exemptions. So you need to be careful as to when you started deciding to do business with that and how you have treated in the past.
Okay. Because I don't want any further running the organization, doing expenditure. I don't mind holding but some more time. That time I said it now. I'm only a seller of a land. I must have developed it now. Whatever income, the difference of profit I'm paying.
No, in your books you should treat it as investments. Okay. You must have your own personal balance sheet. You must treat it as investments.
Fine. One more thing. During this development activities, most of the items supplied by the unorganized sector, whether tractor rent or JCB, you can't even ask the bill from them. That means, we more than about 50-40% we pay to them by a check only. Still, they won't give you any bill. They'll say they'll give it to you, but it goes to the account only. Can I claim that as my expenditure, and will there be any GST on that?
No, as he rightly pointed out, reverse charge mechanism in the context of all other services except construction related services, only for notified services. That means lawyer services, sponsorship services, copyright related, something like that. So if you have procured something from an unregistered vendor, there is no reverse tax on you.
Okay, fine.
But as far as expenditure is concerned, you are paying by bank, you are having invoice, that is, I mean, you are able to account it, that should be enough.
Okay. Only income tax and pay. Yeah. Okay, thank you very much.
You may also have to look at TDS obligations in your hand.
Sir, you said transfer of free tribes and not transfer to GST. What kind of transfer
AAR and AAR versus High Court / Supreme Court. India Pistons, I am aware of that. They subsequently came before discussions. See, the problem with the first, there are two questions raised in that matter. India Pistons first asked whether this was taxable. INOC subsequently asked whether I can take ITC. Both went against the SSCs. They said you cannot take ITC and this is taxable. But this argument, significant argument based on this Panbari T judgment, as well as the concept of salami, as well as the concept of Foxconn, as well as leasehold rights being treated as immovable property by Gasper in Supreme Court, was never discussed. So, not to worry. Unless it's a High Court, not to worry. See, please, one more point I need to convey once for all. I've talked about this in many forums in case you've heard me. AAR, who is the person? Central authority, state authority, sitting officers, which means it's an assessment order. Assessment order, that's all. How much of validity an assessment order will have, you can take it as a precedent.
In terms of, I remember there is a circular notification in terms of payment of GST under a reverse charge for the approval charges. In case of a government.
Covered.
Yes, I got your point. Yeah. No, it's not covered. So, okay, the question is whatever that fees which is paid to the government, so should that also be included for the purpose of making the reverse charge payment? Say you are applying for registration to RERA, you are renewing some of the license. Again, that is kind of a litigative area because the revenue takes the position that everything which the government is doing is a supply of service and the levy is applicable under reverse charge. On top of it, whatever which is paid under reverse charge, in a normal course of business, it is a revenue neutral, so they get an ITC. But for a builder, they will end up paying RCM and no ITC. Now, there is an entry in 12/2017 where the supply of service by a government is exempt, where they are statutorily, which they are bound to provide those service. Now, there is still this aspect, in my view, needs even more the higher detailed forum, because what is statutorily required? Anything actually, if you have an authority like BESCOM or any authority which is set up to give you a license, so in my view it is a mandatory activity by them and should be an exempted service and shouldn't be under RCM. But the position of the revenue authorities is anything you pay to the government, you pay under reverse charge, and this is going to be a litigation for at least a longer period.
I agree. I'll just add one more dimension. When you look at the payment, you look at to whom you are paying, the authority, department, government, and then find out under what mechanism or statute or regulation they are collecting this. Now there are three kinds of payments. One could be actually a levy. It could be a tax or something else. So there will be one municipal act or something through which they levy this development charge or something like that. If it is a levy or a tax, it can never be consideration. Because if it is the case, you have to pay GST on income tax also. Who knows? Notice may also come. So if it is a levy or something which has got the character of tax, out. If it is a charge, but there are clear legislations which govern that charges, then it becomes a statutory obligation. Logic is very simple. If I don't pay, can I run my business? If I don't pay, will my license be cancelled? If the license can be cancelled, then it is a mandatory statutory payment. It does not have a character of consideration. Third one is a fee. Many of them collect it as fees. That is tricky. That is taxable. In fact, even your MCA fees can be taxed. A lot of corporates pay MCA fees for your filings. Even that can be taxed under reverse charge mechanism because that notification is so wide. Whether royalty paid for mining, etc. is a tax or not is pending before 9-member bench of the Supreme Court. So that judgment will change everything. Hope I've answered it.
Sir, what happens is planning authority, example, CMDA collector, not only issuing plan sanction, he collector, development for road, lake development fee, electricity development charges, that's all should be collected by the respective department. But planning authority started including every development fee as a part of their planning issues.
Most of them collect it on the ground that they are actually operating under legislation where the powers are coming from that Schedule 12 or Schedule 13 of the Constitution. Then it takes the character of statute.
Sir, what will happen is after the OC, if you have incurred as a swimming pool, compound, and ATC will get lapsed due to Schedule 3? Input tax credit.
No.
Once my OCs, once I obtain the OC, it will be converted into the Schedule 3. So that whatever the activities has been done after the OC, notwithstanding the ITC, that it's been ineligible, right?
No, but
take a scenario
like
that
swimming pool or anything,
swimming pool or compound, whatever may be the case.
In a residential project, where is the ITC? Whether you do before OC or after OC, earlier this...
Only commercial you can take the proportion.
Yeah.
1419 onwards,
nothing.
It will get lapsed.
Yeah, it will die.
that Safari retreats. Sir has asked a question on the rental, that is, take a mall. Okay, the developer builds the mall with a lot of efforts. He engages L&T, he engages a couple of contractors, spends a lot of money, there is GST in it. And why does he do it? He gets about many units in the mall, which he is going to let it out, on which he is going to pay GST. Now just go back to a factory manufacturer. He puts up a huge factory building, 3 years later manufacture is going to happen, he is going to pay GST. But 17.5C and 17.5D of the CGST Act denies ITC on works contract services as well as goods or services used in respect of immobile property. So a typical mall is viewed as an immobile property, building is viewed as an immobile property, warehouse is viewed as an immobile property, cinema theatre is viewed as an immobile property, you can't get the credit. Orissa High Court, it was challenged on the ground that it defeats the concept of GST. Because GST is value addition tax. Value addition tax is effective only if you give ITC. And Orissa High Court read down the provision and said that based on earlier principles of Acer Motors, because GST has got a philosophy of defeating cascading effect of tax, 17.5C violates that and hence it will be read down, you can take credit. So based on that decision, many businesses have started taking credit. Now matter is pending before the Supreme Court. It was supposed to be argued on November 23rd, it didn't happen. The matter was adjourned. Mr. Ganesh is arguing the matter, senior counsel. So if Supreme Court says Orissa High Court is correct, then fine. If Supreme Court, going by the latest trend, says Orissa High Court is wrong and has to be reversed, then you depend upon how you play your IT. Take the ITC, don't use it. Because if your time limit is over, if you don't take the ITC by the due date specified in 16.4, take the ITC and ensure that you pump in electronic cash significantly to keep the electronic credit balance significantly, so that in case Supreme Court reverses it, you can simply reverse the electronic credit, there is no utilization, there is no interest. But if you use it off, and Supreme Court says Orissa was wrong from day one, which is the effect of that, you may pay interest on the transaction. So practically we have advised, take it but don't use it because of the interest consequences. Then there is further interpretation that you can look at the profile of the procurements and confine the interpretation of Safari only to civil and civil structure. Your HVAC, your plumbing, your elevators, your lifts, your travelators, all those things are all equipments, machinery, etc. You can group it under a general category. There are enough IT decisions on it. That way Safari will affect only some part of your overall pool of ITC. So some planning is required. We'll stop with that, sir. Any other field?
So the landlord getting goodwill from the developer. Goodwill attract GST.
Landlord getting goodwill?
Non-refundable deposit, sir. Under GST.
Oh, NRD. Okay. Non-refundable deposit.
Yes, sir. Consideration to...
See, interestingly, what the law says is, developer has done a service for the owner, mainly construction service, for which they have given a mechanism to valuation. Now, landowner receives NRD. Now, why is he receiving it? Because he signed a joint development agreement. So, at best, you can attribute that money for the development rights which he gave, which is exempt in his hands. No GST.
In the landowner's hands.
In the landowner's hands.
Developer under reverse charge. In the computation mechanism. So, the developer, landowner got some apartments and some money. What is given in the law is valuation of apartments. So the total consideration is valuation of apartments plus the money received. So that has to be used for the reverse charge computation by the developer. For landowner, it is exempt.
For the project development, is there any scope to argue that this 3/2019 is applicable where I can take 5% tax?
I'm trying to say it is not even taxable. You want to get into 5% taxation.
Any interpretation?
Look, he hinted at it. He hinted about that project definition, apartment definition. But can you interpret apartment to include a plot? No. Be a little bit far-fetched. Because 3/19 is very clearly designed for those IA, IB, IC, those specific categories. No? Unless you fit it there. As one last category, other construction service, that is 18%.
Yeah. So the FAQ has originally when the notification came, the word used was registered developer, but registered the promoter. But later they have clarified whether or not the landowner is registered or not, the reverse charge is applicable. It's there in the FAQ.
See, reverse charge is a very powerful mechanism which makes only one person liable. And that person is fixed always. Okay, it can't shift, it can't oscillate. There, for example, take GTA. GTA is one area where they've given an option that you go under forward charge. If you don't go under forward charge, he'll go under reverse charge. Say like that. There are specific categories. But if somebody becomes liable under reverse charge, it will never shift to forward charge to the other person. Similarly, if somebody is liable to forward charge, if he is not paid, you can't ask another fellow saying he has not paid, you pay reverse charge. That is very clear because it is charge.
If a joint development agreement is silent on who pays the GST, whether the landowner pays or the developer pays, is the landowner in any way responsible?
You have a great case. You have a great case where if the agreement is silent, there is no way a developer can develop the GST, collect the GST from the owner. This is law. This is legal. Practically what happens, developer will not hand over key. So the old man and the grandchildren will have to wait for the key. 95-year-old man, I already told you. Then if some other complication happens, the entire power will collapse. 95. Therefore, in all the family's interest, they will decide and pay something and collect the flats. I may be a lawyer, but I will go for a solution.
Thank you, sir. We have come to an end of excellent session, and especially the post-lunch sessions are supposed to be sleepy. I think you did quite a bit of justice to keep the audience awake and and be in touch with the seminar today. On behalf of Bangalore branch of SIRC, I thank you for taking your time out and coming forward to take this session and improving our knowledge kitty. On this behalf, I request committee member Shripad.
And thank you and compliments to branch for structuring special exclusive program like this for 2 days per year.
Yeah, also the credit goes to our program coordinator as well. Also, I request Vinay sir to come upon the dais. No, I think this program was structured on our request, so I wanted to come this side rather than being on that side of the stage, and hand over a moment to Vaitheeswaran sir.
Pleasure to receive from you.
Thank you so much, sir. We are the students of Vaitheeswaran, sir. It's like a blessing for us to share the dais with sir. It's a great honor for us to be with him, sir. Thank you so much.
Thank you, and I'm extremely proud of my students for doing so well. Thank you so much.
Request Shripad to hand over a memento to our speaker as well, Venugopal G. Of course, lastly, the thanks goes to the audience as well, who made this program a great success, and for your patient hearing and actively participating in this today's seminar. Thank you, everyone. Look forward to see you in further more events as such. Good night.
Wonderful, sir. I enjoyed it. Thank you so much. Thank you. We'll keep in touch. Today, I planned it so much. In fact, another client called me and said, will you come? Yes, I have appreciated you. Okay. Next time, I shared your number. I have your numbers. We'll keep in touch.
But your material is one good power platform. In the case like everything. I don't know how many can make use of it, but for me it's a good one.
I'll make it to you.